The bond market has this confidence that the Fed is going to stick to its 2% inflation target.
If you get a really bad print on inflation this week, then I think the long end could easily go up.
We are expecting the Fed to cut rates.
If the Fed wants to cut rates to stimulate an economy with no excess capacity, they're just going to create more inflation.
We think inflation, lingers a little higher.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Tuesday, looking for some big revisions. Economists expecting another big jobs markdown to set the stage for rate cuts. As the Goldman Sachs boss is playing down just how restrictive Fed policy is, the stock market is once again within 0.1% from all-time highs just days after weaker than expected data.
There's a real contradiction here, and I feel like everyone is struggling with this. On one hand, people are pointing to a labor market that clearly seems to have entered a new cycle of some sort. Yesterday, we saw consumer expectations for finding a new job fall to the lowest in a series of data going back to 2013. At the same time that inflation expectations are ticking up. Square that circle. You expect there to be enough weakness to tamp down inflation and yet not enough weakness to torpedo a risk rally. This is what people are struggling with.
Well, let's struggle with the weakness we might see in the labor market once again later on this morning at 10 a.m. Eastern time. We could see a major benchmark revision, 800K, maybe even a million.
And that means that for this White House, it is going to be incredibly challenging to try to explain what is going on as they are trying to say that there is strength right now in this economy. The fact of the matter is, if we get this second revision compared to what we saw also last year, overstating potentially the economy by 1 million jobs, you basically have to look at this and say the Trump administration inherited a much weaker economy than many thought. And that is why it is so interesting that the Wall Street Journal has this report that right now Trump's advisors are looking at a report that might be very critical to the BLS.
Yeah, the timing here is pretty important, isn't it, Lisa? If we get these massive revisions once again, it's another reason for this White House to put more pressure on the BLS.
On the BLS at a time where they already have gotten rid of the head and potentially might get rid of other people. My question isn't who are they going to get rid of, it's who are they going to put in? What are they going to do to fortify the methodologies of the Bureau of Labor Statistics so that they are more reliable statistics? But in the meantime, you have a situation where a Federal Reserve has been relying on numbers that have overstated the economy, which raises the specter of being late. And how do you play catch up given the lack of certainty around where we are currently in the economic cycle?
And how does Trump explain the Fed cutting rates that in September? Remember, it was like around this time last year, he was on the campaign trail at a crypto bar in downtown New York. The Fed cut rates and he was asked about it. And he said, well, actually, that means the economy is probably weaker than we expected under the Biden administration. What is he going to answer for this time around?
Look, the Fed is often criticized and sometimes correctly, but last year, if we are a whole lot weaker than we thought, to Anne-Marie's point, the Federal Reserve and that push to cut interest rates by 100 basis points is vindicated based on the revisions we might get later this morning.
So if they're vindicated, why are people so excited about the start of a new cycle? This is what I was alluding to earlier, this idea that risk assets, as you were talking about, John, so close to all-time highs, closing out yesterday with the NASDAQ at all-time highs yet again, one day after another, creeping into this risk asset rally of a Fed that's going to backstop it at the same time that we're talking about a potential sea change when it comes to labor market dynamics. Dan Greenhouse yesterday really nailed it from Solis when he said something feels different and no one should look for a turn in the labor market cycle.
It's a super odd disconnect right now. The labor market's asking for rate cuts. Financial markets are priced pretty richly here, which goes to the point that the Goldman Sachs boss David Solomon is making. Look, when David Solomon is talking about interest rates, he's talking about financial conditions. What the market needs and what the economy wants can be two very, very different things. And that's what's interesting about this setup. The labor market is asking for rate cuts. Financial markets aren't at all. Ed Jardini joins us later this morning, and he's talking about the prospect of financial instability if this Federal Reserve goes big in the next few meetings.
He, to me, has one of the most interesting points because he's been talking about the roaring 20s and how a lot of what we're seeing in terms of market activity points to that roaring 20s. You get a rate cut, you turbocharge it into bubble territory, and then you have a problem. On the flip side, how far divorced has the S&P 500 gotten from the underlying economy, given that small businesses lower income families are all struggling with costs of housing, costs of basic goods, costs of cars that are skyrocketing out of their income bracket.
The stocks are up again this morning, positive by 0.1% on the S&P 500. Coming up this hour, we'll catch up with Max Kettner of HSBC on why he's bullish into year-end. We'll speak to Neil Dutta of Renmac, looking ahead to big revisions on US payrolls, and Oksana Aronoff of JP Morgan Asset Management warning the Fed risks spurring inflation. We begin this hour with stock steady following a record close for the Nasdaq 100. Max Kettner of HSBC writing the following: we remain firmly risk-on into the final 4 months of 2025. We remain overweight both high yield and equities, preferring US equities the most. Max joins us now for more. Max, welcome to the programme, sir. You're bullish into year-end. Let's start with why.
Yeah, good morning and thanks for having me. Look, I think actually what you guys were just talking about, how sort of disconnected can the S&P become from the overall economy. Let's remember that actually the Q2 reporting season has been pretty much the best earnings season since COVID, since 2021, since we had these ridiculous strong earnings beats, both in terms of the earnings beat rate, but also in terms of how much companies have surprised to the upside. So we're just exiting Q2 with really the biggest corporate strength in about 4 years. So I would say there isn't really much of a disconnect. There might be a disconnect on the weakest part of the economy, but that's not what the S&P, of course, is representing, particularly not the mega caps. And of course, the weaker dollar effects, they really, really do help, particularly the largest companies within the S&P 500. And that's still going to be the case in Q3 and Q4. Bear in mind that not only is it the Q2 reporting season, not only the beats that we just have seen, it's not just about Q2, but it's also about going forward. When we look at our own data, we run something called guidance sentiment indicators, where we look at really the forward-looking statements of CEOs and CFOs in earnings calls, and they're telling us both in Europe and particularly in the US, things are getting better. It's not just about tariffs. It's not just about the day-to-day noise on politics, but really the underlying corporate strength is improving. And on top of that, when we look at the number of companies within the S&P upgrading their guidance relative to the ones that are downgrading their guidance, that clearly is going up as well, in particular also since the reporting season. So all of that is telling us underlying corporate fundamentals have in fact improved very much, and particularly in the last 2-3 months around, since the end of Liberation Day, really.
So, Max, perhaps we should be even more specific. The disconnect we're talking about directly is the disconnect between the labour market and corporate profits. And, Max, given everything you've just said, is that a disconnect that needs to reconcile anytime soon? Can we carry on minting fantastic corporate profits even with this weaker labour market?
I do think we can, because let's remember that what's happening on the labour market is really a weaker labour market and much, much lower payrolls, in large parts because of the reversal of immigration, right? It's not because, it's just about demand. I'm sure there is also some demand effects going on there as well. But let's remember a large part of that is because we had this massive, massive reversal in immigration flows really since the start of the year. And that, of course, is really prompting payrolls and break-even payrolls in particular, so that the number of payrolls in order to keep the unemployment rate steady and unchanged, it makes it much, much lower and probably in the next couple of months even converge towards zero. And that, of course, means that, even like 100K number on payrolls is pretty much unthinkable, I think, for the time being, given, again, that reversal of immigration flows. That is not yet really affecting economic activity. Can that do so maybe in 2026 down the line? Sure. But in the next 6 months, let's remember, we got fiscal stimulus, we've got even more fiscal stimulus. Next year, we'll probably have some positive effects from even higher tax rebates. We've got a positive wealth effect from real estate prices, plus obviously from higher equities. We've still got positive real wage growth. All of that really still keeps consumption still pretty healthy. And then you look at corporate profits and you look at that AI tailwind, which now is affecting pretty much half of the S&P, plus the tailwind from the weaker dollar. All of that is a perfect cocktail for further risk on. And then on top of that, you throw on rate cuts that actually from a growth perspective, we kind of don't need. And certainly from a financial condition perspective, we don't need. And that's an even more potent
cocktail,
cocktail,
a second,
I
Max,
think.
because if what you're saying is correct, and a lot of the labor market weakness is a head fake that really is predicated on a complete change in immigration, then why aren't you in the Ed Yardeni camp that any kind of rate cuts is only going to turbocharge a financial asset bubble that will lead to financial instability?
Yeah, but look, even if that was the case, Lisa, let's remember, if this was to prompt a financial asset bubble, or if this was to end up in sort of a financial asset melt-up, what do? Well, you risk on. You really invest in those assets the most that benefit from a continued higher nominal growth world. What's the best liquid nominal asset class? It's equities. And, you continue shunning particularly long-end bonds, particularly the 30. I think the rally that we've seen in the last couple of days, from 5% down to almost 465 in the 30 in treasuries, that really doesn't look justified in that regard. So even if it was to lead to a bubble down the line, fine, it's down the line. Is that already the case now? No, that still means I need to get exposure to that nominally most growing asset class, which of course is equities.
So, Max, there are a number of people who are throwing things at the TV this morning as they listen to you. Neil Dutta, who's going to be on in just a bit, is one of them, who says that he rejects these arguments and actually sees no case for reacceleration next year. Other people might be people who just recently graduated college and cannot find a job, as well as anyone else who is out of a job and is having the hardest time in data going back to at least 2013 finding new employment. How do you sort of discount that in your scenario of a reacceleration? Is that just noise, or is there something else going on here that potentially clouds some of this story?
No, I do think on the labour market is probably somewhat really different from the broader activity perspective right now, right? From the broader backdrop right now. Simply because when you just looked at the labour market and said, look, probably firing is still pretty low. Yes, job cuts have gone up, fine, but they're not yet at levels that really are kind of telling us we should be overly concerned yet. But of course, in order to get a job, it's pretty tricky. So the labour market is probably somewhat disconnected from the broader activity standpoint. Can that go on for 3, 4, 5 years? No. Can that go on for another 3 to 6 months? Absolutely. And then again, down the line, maybe at some point in 2026, that needs to reconnect. Absolutely. But for the next quarter, next 2 quarters, I think that disconnect can continue, in particular if we do get the rate cuts, and that then spurs a bit of extra activity. We get the positive lagged impulse from those rate cuts coming through, because you also said in terms of reacceleration, you mentioned that reacceleration. Let's be honest, we look at all the high frequency data, that's all pulling up. We look at, even on the labor market side, the temporary staffing index has been going up in the last 2 months. Same store retail sales are going up, credit card data is going up, even Visa spending momentum index is going up. So particularly on the consumption side of things, since the end of June and the beginning of July, so really the last 2.5 months, high frequency data in the US, particularly on the consumption side, really is looking like it's actually trending up a little bit. And we are seeing that in aggregate nowcast as well, or proxies. Look at the Fed's weekly activity index. That's been going up as well in the last 2 months. As well as you look at the Atlanta Fed's GDP now, we're tracking at 3% for Q3, which is much higher. Consensus started this quarter with round about 0.5% of GDP growth. Again, much higher than consensus growth. So overall activity, broader activity, industrial production, retail sales, consumption, all of that is still really healthy, and if anything has shown signs of improvement in the last 2 months.
Max, we're getting closer. Let's put a bow on it. I'll just be direct. What would make you bearish?
I think one thing that would make me bearish is if we get really 2-3 months of negative payroll data, that probably would be what makes me quite cautious, because then we get the rate cuts for the wrong reasons. Then we get the rate cuts really because activity has already slowed so much.
Max, you don't think that's what this is right now? No, because what this is really, I think a lot of this, what this is really due to immigration reversal, right? So I do think, look at what we had over the last 4 or 5 months. Yes, the unemployment rate has gone up, but it's really edged up very, very slowly, even though effectively, we've seen payrolls almost go to a standstill. And that, of course, a lot of that has to be due to that immigration reversal. So it's very hard to really disentangle the immigration flows or the demand and the supply effects there, really. So I don't think we're quite at that point yet, and particularly financial conditions don't tell us that, right? Financial conditions, when we look at credit spreads, we look at equities, all of that, again, tells us that actually we continue to have a positive wealth effect, we have positive real wage growth, and let's be honest, the first 10% in terms of income percentiles, they account for half of consumption. So as long as that is ticking along nicely, that actually tells us that consumption overall is still
continuing to be on a very strong footing, I think.
Max Kettner of HSBC. Max, enjoyed this. Thank you, sir. The bullish case. Standing up the bullish case this morning.
Yeah, talking about how a lot of this is a technical ramification from immigration. Other people would argue that there's a positive spin. If there was slower momentum heading into this year, well, it hasn't slowed that much more materially if we did come off a low base. Other people would argue, can you really discount college graduates? Can you really discount people who lose their jobs and can't find a new one? Can you really discount sentiment that's really been deteriorating?
Also, what about last year? The fact that we had 800,000 jobs lost, those revisions last year, before Trump came into office, before there was new immigration policy. So this would be the second time in a row that you have a massive downward revision. Only one time of that, partially, immigration policy is impacting the labor market.
This debate is going to continue. Neil Dutta, of You Said, is going to join us later on in the programme. Neil's going to have some things to say about the argument that was just presented. So we'll get a range of views this hour. Before we get there, let's get you an update on news worldwide with your Bloomberg Brief. Here's Yahara Anand. Hey, Yahara.
Hi, John. French President Emmanuel Macron is searching for a new prime minister for the fifth time in less than 2 years after Francois Bayrou lost a confidence vote in parliament. Bayrou will present his government's resignation to the president this morning after failing to win support for his plans to cut the deficit. Macron says he'll appoint a new premier in the coming days. Meanwhile, here, President Trump extended his immigration crackdown to Chicago. Operation Midway Blitz is targeting what the White House calls criminal illegal aliens in the city and other parts of Illinois. The Department of Homeland Security blamed Democratic Governor J.B. Pritzker for sanctuary policies that it said helped protect lawbreakers. And the Senate Banking Committee will vote tomorrow on White House economic advisor Stephen Miron's nomination to the Fed Board of Governors. This paves the way for potentially full Senate confirmation September 15th on Monday, just 1 day before the Fed's critical policy meeting. The central bank is widely expected to cut interest rates for the first time since December. That's your Bloomberg Brief. John?
Yahara, thank you. If we could live stream that meeting, box office, pay-per-view next week.
That, I think, especially with a newly placed Stephen Miron. Can you imagine? Do you think that some people will not want him to sit at their table? Do you think it's going to be like high school?
Like Mean Girls?
I think a little bit.
Can't sit with us.
Yeah. Actually, no, I'm sorry.
Like Chairman Powell?
You can't share my paper.
Yeah. Up next on the programme, not that. The BLS under pressure.
We need accurate numbers coming from BLS. And finally, we'll have new leadership to deliver. Donald Trump needs to rely upon the numbers. America needs to rely upon the numbers.
Just what is going on? We'll get the view from Bloomberg's Mike McKee in just a moment. Live from New York City this morning. Good morning. Record high at the close on the Nasdaq 100 in yesterday's session. On the S&P, within just 0.1% of all-time highs on the S&P 500. Just the day after, the trading day after, a weaker than expected payrolls report last Friday. This morning on the Russell, small caps just about unchanged. Under surveillance this morning, jobs in focus once again. The BLS under pressure.
So they need new leadership in BLS. That's for sure. They need new tech in BLS. That's for sure. And Donald Trump needs to rely upon the numbers. America needs to rely upon the numbers. You can't have these bent former administration people who have a view and who want to harm the president. We need accurate numbers coming from BLS. And finally, we'll have new leadership to deliver.
So here's the latest this morning. The White House ramping up pressure on the Bureau of Labor Statistics. People familiar with the matter telling the Wall Street Journal that President Trump's administration is preparing a new report critical of the agency. With the latest, here's Bloomberg's Tyler Kendall. Morning, Tyler.
Hey, John. Good morning. Well, this, of course, comes against the backdrop of an unprecedented level of criticism by the White House against what's historically considered to be a routine process. And the Wall Street Journal is reporting that the administration is weighing publishing this report compiled by the Council of Economic Advisors on the BLS's alleged shortcomings within the next few weeks, signaling to us that this pressure campaign isn't going away, particularly as we wait for these preliminary benchmark revisions today, though they only cover part of the first 3 months of the Trump administration, it's likely opening the door for officials to criticize the last administration. But this White House has been really critical of the revision process, and experts tell us that these revisions have been larger in recent years, partly due to declining response rates. Now, we're watching really closely a few different things here, but I will point out that the NEC director, Kevin Hassett, did suggest to me on Friday that he actually thinks August numbers are going to be revised up. He pointed to a recent analysis by Goldman Sachs that suggests that the later reporting submissions for the month actually tend to be higher. So a few different justifications from the administration, but it's clear that they are going to keep ramping up this pressure campaign. And John, as you well know, August numbers marked the first time that the new report came out since President Trump had fired the last BLS commissioner. Currently, there's an acting commissioner in place. He's been at the agency since 2015 as we wait for the Senate to take up President Trump's pick to replace the last commissioner. That's E.J. Antoni. He's currently the chief economist at the Heritage Foundation, a conservative organization based here in Washington. As of yet, there hasn't been a nomination confirmation hearing date set quite yet.
Tyler Kendall with the latest. Tyler, thank you. Appreciate it. Bramo, we've been through this a few times. Does it feel different this morning? Does it feel different this time?
Well, it feels different because of the response coming from the White House and the likely changeover in staff yet again. It also is different in terms of already the changeover in staff that we've seen with respect to not only the top of the ticket, but also below some of the career staff members. Why should they stay? And so this raises a question, not should things change, how should things change, and exactly who are they going to be putting in that place?
Also, I think the administration needs to get on the same page on whether or not they like certain research at certain banks. You just heard Tyler there talk about how Kevin Hassett is saying how Goldman Sachs is saying he's seeing this revision potentially from August. It's a noisy month. What did the Treasury Secretary say over the weekend? He made a career, a living betting against Goldman Sachs.
I think we're cherry picking just a little bit. Let's cherry pick a little bit more with Bloomberg's Mike McKee. Mike, good morning, sir. I'm joking, of course. Walk us through the process that we can expect to go through later on this morning.
Well, basically, John, once a year, the BLS updates its data using unemployment insurance records that come in. It's the quarterly census of employment and wages. And then they put out a report that aligns those numbers with what they've done the year before. And they do it for the year that ends in March. So what we're going to get today is a report that will say in March of last year, there were somewhere between 800,000 and 1 million fewer jobs in the United States. And then you compare that to what the BLS had initially reported, and you get the difference that we're talking about. So the issue is not so much whether the BLS is manipulating things, it's the size of the change. Last year, 800,000 was the preliminary estimate. I stress preliminary because these numbers will be revised again by the time they are finalized in February of next year with the January employment report. Last year, we had 818,000 initial preliminary job losses, but it ended up being 589,000.
Mike, just quickly, there have been a lot of economists who've been critical of the Bureau of Labor Statistics data just by virtue of the response levels, how quickly the responses come in, as well as some of these revisions. What are some of the tangible things the BLS could do to make their data more reliable for Wall Street and, frankly, during the first read, not just the second, third, and fourth reads?
Well, this is one of the issues here because this CEA report seems to be the president says there's something wrong, so we're going to find something wrong. Well, everybody who has worked with the BLS or is in the statistical business knows some of the issues, and you've talked about them, the low initial response rate. COVID caused a lot of issues with seasonal adjustment, hiring patterns changed. That's working its way slowly out of the data, but it's still in there, and everybody knows that's the case. They're also severely understaffed, 20% fewer workers than they had in January, thanks to the DOGE efforts and the president's efforts to fire people and early retirements that were offered. And they've been having their budget cut for years. So to develop new systems, to update their computer systems, et cetera, hasn't been possible. So there's a lot that could be done if you wanted to sit there and say, how do we fix this, rather than just criticize.
Mike McKee, appreciate the update. Stay close. It's going to be a busy morning for Mike. Just think about to those payrolls Fridays. Think back to those days over the last 12 months. If they were 70K lower, how different the conversation and the market action would have been on any given morning.
And how much the Fed has to play catch up, just like they did last year around this exact same time.
Up next on the programme, we'll get Neil Datta's view over at Renmac as we await payroll revisions. Plus, we'll touch base with Danny with your morning movers as an AI cloud deal sends one stock absolutely soaring. Pretty muted price action to kick off the trading week. Equities just about positive in the last 24 hours, up again this morning by a tenth of 1%, within a tenth of the close yesterday of all-time highs. Record highs on the Nasdaq 100, four-day winning streak coming into Tuesday. Speaking of a four-day winning streak, check out the front end of the yield curve. For 4 consecutive days, yields lower. Yields a bit higher this morning by a basis point, but lower over the previous 4 sessions to 349.85 on 2s, on 10s. The last time the Fed met, the yield on a 10-year was around about 423. 2 week payrolls later, and we're testing breaking down to the 3s. It's a big change in this bond market.
We haven't just seen a change in when the Fed could cut rates. It's a matter of how far they could go in this near term. We're now talking about the possibility of a 50 basis point rate cut next week, but more importantly, a neutral rate that is far below where we thought maybe just a couple of months ago.
The Federal Reserve gearing up to cut rates. The Bank of Japan might be hiking. Check this out. Dollar yen with this move, negative by 0.75% on that currency pair. That's a stronger Japanese currency so far this morning. The team here at Bloomberg over in Tokyo reporting that the BOJ and officials are of the view that it might be possible to raise benchmark interest rates again at some point this year.
Despite some of the political pressure that they could face, given that Prime Minister Shiba is stepping down, this is just coming days after the yen sold off, this weakening that we saw on the heels of that announcement. Now people saying, wait a second, maybe the Bank of Japan is independent?
Possibly. Maybe. 146 on dollar yen so far this morning. That's the currency story. 3 hours away from the opening bell on the equity side of things with your morning movers. Here's Danny with more. Hey, Danny.
Hey, John. Some real deals coming into this market. One that was announced was Nebius. This is a AI infrastructure provider making a deal with Microsoft, providing them with some $19 billion worth of infrastructure. This is remarkable for them. You can see just the share price reaction up 50%. It's listed in the U.S., but it's Amsterdam-based. It used to be Russia-based, and it was initially sanctioned in 2022. The company since has sold off its Russia assets. So what a turnaround for this company. The other big deal to work through for this morning is Anglo American buying tech. That company up nearly 12%. It will create a $50 billion behemoth in mining. What does Anglo want out of this? They want their copper resources, high quality, that have been very sought after. So again, a big rally in tech share prices this morning. Elsewhere, Dell announcing late yesterday that its CFO, Yvonne McGill, would be stepping down. Analysts over at Morgan Stanley noting that this is really odd timing. It comes just 11 days after their earnings, 29 days before their annual investor meeting. Not exactly an ideal period to announce a CFO change. Michael Dell said that the reason was because of fatigue. The response in share prices down 1%, John.
Danny, appreciate the update. More from Danny in the next hour. On our radar this morning, some of our top stories. Wall Street preparing for payrolls revisions from the BLS due at 10 a.m. Eastern Time. Nomura, Bank of America and RBC saying labour market data could be downgraded by nearly 1 million jobs. Elsewhere, South Korea's foreign minister is in Washington today, the country's top diplomat, looking to secure the release of about 300 workers detained after a DHS raid at a Hyundai plant in Georgia on Friday. And finally, Anglo-American shares surging in London, the mining firm agreeing to merge with Canada's Trek Resources, creating a copper giant worth more than $50 billion. The combined company will be called Anglo-Tech and headquartered in Vancouver.
This is fascinating on so many levels. On one hand, both of these companies have been fending off offers, pitches by the likes of BHP Billiton and others who want to acquire them. They would be smaller than BHP, but they would be at least somewhat of a rival. Do they get the approval of their respective governments? Because this has been a crucial area, how much to preserve some of the key mineral rights in order to have a national security. Do they get the Canadian and the London and the UK approvals that they need to get this through?
And does someone else step in? Because I'm pleased you talked about what they've been fending off. Anglo, of course, they were pursued by BHP. Glencore went after Tech Resources, I believe. These are going to be copper pure plays. This is ultimately what Anglo wants to be, selling down platinum, selling off De Beers. Diamond price is terrible at the moment, by the way. We could talk about that another time. Not a great time to be selling that asset. But ultimately, this is still going to be very attractive to a lot of players out there. And I just wonder if, in the next 12 months, this deal is disrupted by more than one thing.
And it would take 12 to 18 months to get it through. You've got the potential rival offers. You have the potential pushback from national governments. And then you have a question of just in general, does the market sour further, making this deal, the economics of it, somewhat challenging, given the fact that China supposedly is going to be retrenching some of their overproduction?
But this is because the miners really want the copper assets. When you look at how much is being produced, Anglo American produced 770,000 tons of copper last year. Teck is more than 500,000. You're talking about more than 1 million tons of copper when these two companies are able to combine. But already the deal was going on in the behind the scenes because others were trying to go after these exact assets. So I think your point is spot on. There's potential that this deal doesn't even make it to the finish line.
It's going to be interesting 12 to 18 months for these two companies, that's for sure. That's the latest on Anglo and Teck Resources. Turning back to the US economy, BLS benchmark payrolls revisions due at 10 a.m. Eastern time. The data coming on the heels of Friday's disappointing jobs report. Neil Dutter, the head of Renmac, writing the following. The latest employment data cements at least 2 rate cuts this year. Neil joins us now for more. Neil, welcome back to the programme, sir. Appreciate catching up with you. I've just framed the debate on Wall Street at the moment, and I want you to push back against one theory that's still out there. There are some people who believe this step down in payrolls growth is a bigger result of what's happened on the supply side of the economy. Neil, what would you point to push back against that this morning?
I mean, I would say look at the unemployment rates for those at the margins of the labor market. The unemployment rate for blacks has been rising. If you look at the unemployment rate for younger people, 16 to 24, that's been rising. If you even look at the unemployment rate for those with college degrees, that's been rising. So unless we had a bunch of black folks and those with college degrees swarming across the border over the last number of years, to me, it's a little bit of a stretch to say that this is primarily about labor supply. At the same time, I mean, forget the BLS data for a moment. Look at what consumers are telling you about the job market. They're telling you that it's getting harder to find a job. That was released in the New York Fed survey yesterday. That's true of the Conference Board survey yesterday. So for all this talk about whether there's, the data quality is strong enough, look at what consumers are saying. If it was all about labor supply, the consumers that are being surveyed by these, by the New York Fed or the Conference Board, they wouldn't be telling you that labor market conditions are getting worse. So, to me, I think the most important thing, let me just make this last point. It's very important for people not to rationalize away a slowdown in the job market.
Neil, some people would argue, not necessarily rationalize, but would argue that corporate profits are turning up. You've got companies in a better situation, and as soon as they've got a greater degree of policy certainty, they're going to go out and they're going to hire more, and you'll see some sort of unleashing of the labor market, that essentially there has been a disconnect between some of the corporate returns that would have been reported versus what consumers are telling you, and that won't necessarily come together in a bad way. How do you push against that?
Well, I mean, financial conditions have been loose for a while, so why hasn't it already happened? I mean, I think... there's the uncertainty around trade policy, but then there's the trade policy itself. And you could make the argument that now that the uncertainty around it has come down and we kind of know what the cost structure is going to be, now companies have an opportunity to react. And given the fact that the effective tariff rate is, 10, 11%, that would mean that they take steps to deal with that, namely by potentially raising prices on goods or curbing. I think what's more likely is curbing back on hiring and investment.
Later this morning, we're going to get revisions to the Bureau of Labor Statistics data that might show that heading into April, this economy was already in a much weaker position from the labor market perspective than previously anticipated. How much do you think that the BLS data is responsible for a lack of clarity around just how weak the labor market is?
I mean, the data are what the data are. I mean, I think the economy's been slowing for a while. Remember, going into the year, I mean, the consensus did anticipate some slowdown in the economy already. But the data had been consistent with, low rates of firing, low rates of quits, low rates of hiring. It's a very, very sort of sclerotic labor market. That's the labor market that the Trump administration inherited. And it's also important to remember that revisions tend to be, they kind of amplify the trends that were already in place, right? So the fact that the economy's generally been slowing, it's not surprising to see the revisions, skewing to the downside. To me, revisions are more a sign of, things actually being done on the up and up, right? I mean, that's a feature of getting the data right, not necessarily a bug, right? I mean, where the data is hardly ever revised? China. So I do think that it's just, it's important to understand why the data works the way it does. But as I say, it's very much consistent with a lot of the, frankly, survey measures of activity that we've been monitoring.
Neil, do you think we're on the precipice of a recession?
Yes, I think we are. Yes, I mean I've been saying that. I mean I think it's certainly I think the markets are underpriced for the prospect of one. I don't think recession probabilities have really changed all that much from where the markets were, in the immediate aftermath of Liberation Day. But at the end of the day, I think for me, the biggest disconnect or difference between where I was last year versus where I was this year is that, last year I thought the Fed should cut 50 and they would cut 50. So my economic call and what I thought the Fed should do was kind of aligned. This year, I kind of think they probably should do a little bit more up front, but I don't think that they will. Because, in their mind, they're kind of worried about like the phantom inflation expectation story or, the threat of potential inflation coming from tariffs. I mean, I think those are really secondary considerations at this point, given what we're seeing in the jobs market. So to me, I think the risk is that the Fed ultimately won't deliver as much as they should, and that kind of reinforces the slowing that we've already seen.
Neil, the word you just used, phantom, the phantom inflation story. What makes you pour freezing cold water over it going into year end?
Well, survey measures of inflation expectations look fine. I mean, business expectations are low. If you look at the New York Fed survey that was just released yesterday, I think that's a lot more. That's much better than the UMich data. That's basically been flat for a while. Even the small business sentiment data that came out. Look at plans to raise selling prices or those raising selling prices. But ultimately, it comes down to first principles, right? I mean, if you look at the 3-month trend in aggregate weekly payrolls, that's a proxy for nominal wages and salaries. That's running below 3%, right? So consumers don't have the capacity to absorb higher prices. So to the extent that companies try it, they're going to find increasing resistance, which means that consumers are going to ultimately cut back. And then in turn, what are companies going to do? They're going to have to cut prices on the things they tried to raise prices on. So I don't think inflation is getting away from the Fed, which is why I think they should be focusing more on the growth side of the economy at the moment.
Neil, appreciate it. Thanks for joining us this morning. Thank you, sir. Neil Dutta there of Renmac. Essentially, the message coming from Neil and others too, don't worry about the inflation side of the mandate because there are so many more reasons to worry about the labour side of the mandate.
Jim Reed over at Deutsche Bank put it well this morning when he said it's as if Thursday's data doesn't matter. It's as if CPI really, even if it comes in hot, can just get shrugged off and discounted. Even that New York Fed data that Neil was talking about crept a little bit higher from 3.1% in terms of consumer expectations for inflation over the next 1 year to 3.2%. People saying it's not going to really be persistent. This really is, though, an anxiety for some people because some of it hinges on things that are out of their control, like oil prices, like commodity prices. Otherwise, I mean, if you take a look at the North Face backpacks, they're going up. I'm just saying, if you go back to school.
This is the back to school stuff again.
I'm telling you, the bills were higher.
Expensive, was it this year?
It was. I mean,
feels personal.
I mean, look, a box of pencils for $3.50.
You're not letting the pencils go, are you?
It wasn't that much. I know you're rolling your eyes.
No, the president would say you could just have one pencil. Why do you need pencils?
Because they lose them all the time. It's ridiculous. It's horrible.
More stories from Bramo later on this morning about the cost of going back to school. I'm sure a lot of you have shared that pain over the last few weeks. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara with more. Hey, Yahara.
Hi, John. France and Germany are leading a push for increased sanctions on Russia. According to a proposal seen by Bloomberg, the European nations have urged the EU to target major Russian oil companies in its next package of sanctions. A delegation of EU officials are in Washington this week to meet U.S. counterparts and discuss potential joint action. Meanwhile, Rupert Murdoch and his children have settled their long-running family feud. Under the new agreement, Lachlan Murdoch becomes the sole beneficiary of the trust overseeing Fox Corp and News Corp, while his siblings walk away with more than $1 billion each. The move ensures Fox News and the wider empire remain conservative and under Lachlan's control for possibly decades to come. And Lisa should be shopping at Temu. Temu is trying to win back U.S. shoppers after the tariff chaos by slashing prices. At least 24 of Temu's best-selling products have seen prices drop by 18% on average this month, with some items seeing cuts as deep as 60%. Temu has stopped charging buyers import fees and has urged merchants to cut prices to improve traffic on its app. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. More from Yahara in about 30 minutes' time. Up next on the program, the risk of reinflation.
If the Fed wants to cut rates to stimulate an economy with no excess capacity, they're just going to create more inflation. They're going to err on the side of easing.
That conversation up next with Oksana Aronoff of JP Morgan. Let's check out stocks and bonds. Close to all-time highs at a close in yesterday's session. Futures up by about 1/10% on the S&P. In the bond market, the Fed meets a week tomorrow. Decision is just around the corner, and yields are like this: 349.85 on twos, and we were close to 4% at the last meeting. That's a massive change for this Federal Reserve.
Especially because you have not seen any kind of increase in the long end of the yield curve. This appears to be a repricing of the risk of a labor market slowdown. Has that fully been appreciated by the rest of the market? Maybe, maybe not. It's a sinkhole of a debate.
There we go. To put it that way. That's one way of putting it. We'll explain why a little bit later. 2-year bond yields. It's brutal. Down for 4 consecutive days coming into Tuesday. That's the bond market set up under surveillance this morning. The risk of reinflation.
If the Fed wants to cut rates to stimulate an economy with no excess capacity, they're just going to create more inflation. They're going to err on the side of easing. The real question is, are they erring by easing? And that's only going to be known over the fullness of time. Something has changed in the supply dynamics of our labor market, and we need to kind of understand it.
So here's the latest this morning. Views diverging on Wall Street ahead of the Fed's latest interest rate decision next week. Some even betting on a jumbo rate cut. Oksana Aronoff, the head of market strategy at JP Morgan Asset Management, raising concerns, writing, if the Fed thinks the economy should be churning out over $150K a month, that's going to guide them into cutting short-term rates, which is stimulatory for the higher inflation environment we're in. Oksana has made it into the studio, navigating sinkholes of her own through Westchester. It's good to see you, Oksana. Good morning.
Literal and figurative ones.
Thank you for making it. Let's start with this Federal Reserve. What are you actually expecting? So let's make a divide, a big distinction between what you think the Fed will do versus what you think the Fed should do.
That has been a divide for over a year now. We did not believe they should have been cutting last year when they did. We saw the long end react in a way that I don't think anyone anticipated. We anticipated it because, of course, the long end was reacting to realities around technical, supply of treasuries and long-term inflation expectations. And that is the reality, I think, that the Fed will continue to grapple with this time around. Nothing is likely going to stop them from this cut that's coming up this month, even a higher than expected inflation print. And that's unfortunate because I think they would probably benefit from standing still here, looking at what's actually happening in the economy, looking at variables like what's happening with population growth, for example. We are really not sure, given that the border is tighter, there are deportations, right? Population growth is a tremendous driver to jobs, and that is changing. And we're not entirely sure how that's changing. And to the comments you quoted earlier from me, if the Fed is still being guided by the economy needs to be churning out 100, 150, 200,000 jobs a month, then that's going to guide them in a direction that's going to be pro-inflationary.
It might not be 150,000 jobs a month, but it's not a contraction like what we saw in June for the first time since December 2020. It's not these surveys indicating that people don't feel good about getting jobs. Why won't that curtail inflation on its own? Why doesn't that suggest maybe the Fed has some room to normalize policy from what might be considered restrictive?
Well, this is really the issue, is that the Fed keeps calling this level of rates mildly restrictive, or restrictive is continuing to be part of their rhetoric. And it's hard to see where is it restrictive, because financial conditions continue to loosen. They're looser now than when the Fed started their hiking cycle, 3-4 years ago. And so, yes, the jobs backdrop is moderating, but the unemployment rate is still 4.3% versus 4.2% a year ago. Is there some slowing? Without a doubt. That is a natural kind of ebb and flow of the markets and the economy. I don't think this calls for the kind of sort of fever pitch around let's cut. And I'm not sure what cutting is going to ultimately do, because when we cut rates, what are we trying to do? We're trying to improve borrowing costs for small businesses. We're trying to improve borrowing costs for mortgage borrowers. And that's just not really been the case. I mean, mortgages are still kind of stuck in that mid-6, high-6 level, which is not really unlocking tremendous amount of activity. And frankly, even if we give the benefit of the doubt to this policy and say, you know what, it's going to improve the mortgage rate, is that really going to yield better home affordability? What is your average homeowner going to do if they know money's cheaper? They're going to raise their home price further. We saw some of the lowest mortgage rates over the last decade, rock bottom low mortgage rates, and all we saw was tremendous price appreciation.
Are you saying that rate cuts here, even if there is some degree of weakness in the labor market, would only inflate asset prices, create long-term inflation, and do nothing essentially for any of those underlying issues?
Unfortunately, I think there's a very significant risk of that happening. It is going to probably stoke asset price appreciation, which is already at a very rich level. We know that credit, and I've talked about this before here, credit has never been more expensive. Credit has been more expensive, 1% of the time historically. 99% of readings in credit over the last number of decades have been less expensive than where it is today. So price appreciation, although I will say if the Fed is aggressive around price cuts, that may actually spook markets, where markets may be like, well, what do they know that we don't know? And that can actually spark a sell-off in credit or in risk assets, which, look, risk assets are definitely pushing some boundaries there, and a correction is not outside the realm of reasonableness or possibility. But I just don't think the Fed has enough here to really be as aggressive as everyone is asking it to be. However, the Fed has done no favors to itself, right? Over the last 18 months or so, they looked political, whether they wanted to or not, when they, for the first time ever, changed policy within a couple of months of an election last year. And that made them look politicized, whether they were or were not. And so that's why I think the market generally is sanguine around this question of, Fed independence. We're seeing markets kind of look through that. Yes, maybe it's a red flag, but until we see, the White House actually set monetary policy, I think the markets are going to continue looking through that.
In the 30 seconds we have left, how would you deploy capital? Where would you like to put it in fixed income at the moment?
So this is the most important question, because everyone kind of sits here and talks about what's going to happen in with the economy, what's going to happen with Fed policy. But at the end of the day, fixed income specifically, which is the world I live in, is meant to be a ballast in your portfolio. And the problem that investors continue to have, whether they realize it or not, is that bonds and stocks have become highly positively correlated.
Yep.
And so what I think investors need to do is look at their fixed income portfolio and think about, okay, well, rates fell, maybe I did well, but when rates rose, did I do just as well, or was my portfolio positive? And I think they need to really think about that kind of diversification with investors that can generate returns, regardless of whether the environment is a good one for bonds or not.
Oksana, perfect timing. It's good to see you.
Thank you.
Thank you. Oksana Aronoff there of JP Morgan Asset Management. Up next on the programme, Ed Yardeni of Yardeni Research, Henrietta Trays of Vader Partners, Amy Wu Silverman of RBC, and Amanda Lynham of BlackRock. The second hour of Bloomberg Surveillance, up next.
Since the equity market retook its pre-Liberation Day high, I've been a little more concerned.
The stock market valuation maybe are topping out here.
As long as forward earnings estimates continue to climb, we think the market is well supported.
You stick with secular growth, add some cyclical exposure.
Valuation alone is something that doesn't end bull markets.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
At or near record highs coming into Tuesday. Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now, and your scores look like this on the S&P 500. Higher by about 0.1%. Likewise on the Nasdaq, up by 0.2. In the bond market, the setup A week out from a Federal Reserve meeting, a 2-year sub 350, 349.85. Yields lower over the previous 4 sessions, higher this morning by just a basis point. As for this morning, the main event, 10 a.m. Eastern Time. Benchmark revisions from the BLS. Just how much lower were payrolls over the previous 12 months?
Is the Fed behind the curve? And just how behind the curve are they, given the fact that we might have seen a lot slower momentum heading into April from this data that is backwardly revised? You take a look at some of those yields and some of the rate cut bets. Are they cutting for the right reason? Or are they cutting for the wrong reason? And we've heard that debate viciously hashed out on this show so far this morning, and that is the reason why I find this moment so fascinating.
Behind the curve, or as the White House would say, too late. And this is where it's going to get very complicated for them. How do they message that actually the economy is doing well if the Fed is cutting because the labor market is so weak?
Think about the last 60 minutes on this program. We've had Neil Datta of Renmark tell you that we're on the precipice of recession. Oksana Aronoff of JP Morgan Asset Management really alluding to the idea, the argument that maybe this Fed's about to juice this market too much. These are rate cuts that perhaps we don't need. To your point, Bramo, that's the setup going into this meeting a week out.
Yeah, and Max Kettner is saying you got to lean into the bull market because if there is asset price inflation, I'm going to be there. So this is essentially where we're at a time where people cannot understand a highly complicated economy and a market that is increasingly removed from said economy. You just wonder, do the profitability outlooks for some of these companies really improve their hiring plans? Or are they looking to have a business model that just includes fewer people? Is this a secular shift that is getting represented in the numbers and in the sentiment of consumers?
To Oksana's point, though, something that this administration wants to see is lower rates. They want to see lower mortgage rates. But what did we see last year? The Fed cut, and it didn't change mortgage rates. Actually, they went up.
There is a disconnect at the moment between the labour market data weaker and corporate profits and the outlook for those profits a whole lot better. Does that disconnect need to reconcile to explain the price action of the moment? Now, some people are making the case that maybe it doesn't. Now, you mentioned Max. Max is basically saying it's not a big deal, that you shouldn't anchor your view on the stock market around developments in the labour market. That's uncomfortable for a lot of people, but that's the view that ultimately is proved correct over the last month based on the price action alone.
I'll give you an example. Big tech. They've cut hundreds of thousands of jobs over the past couple of years. Remember the year of efficiency for Meta? And the stock rallied tremendously. The more they cut, the better their stock does, because essentially they're saying we can do more with less. At what point is that representative of the profitability that comes in the heels of technology that at the moment is superseding the need for quite as many people? I understand this is just one piece of the story and there could be weakness elsewhere. It is a complicated moment, and putting it together into a coherent story, as you can see everyone's struggling with, not so easy.
All-time highs on the S&P.
There you go.
Apparently it's that simple.
Yeah, there you go.
Equity futures positive again this morning by close to 0.1%. If you are just joining us, welcome to the program. Here's your next 60 minutes. Ed Yardeni of Yardeni Research joins us with rate cut bets rising. Henrietta Trays of Vader Partners as South Korean officials look to secure the release of detained Hyundai workers. And Amanda Lynham of BlackRock with Treasury yields falling ahead of key inflation reports. We begin this hour with stocks nearing a new record as investors weigh the Fed's next move. Ed Yardeni of Yardeni Research writing this. Our concern is that lowering interest rates will lead to financial instability. Solid productivity-led growth in real GDP implies that current interest rates are just fine where they are. Ed joins us now for more. Ed, good morning, sir. Is this a market then that you want to lean into?
Absolutely. It's a bull market. It's been actually a bull market since the last recession. The last recession was a 2-month recession back in 2020. Remember, with the lockdowns, we made a low on March 23rd, 2020, and that's been the market's up about basically 100% since then. And almost all of that can be accounted for by earnings. I mean, once the market recovered from the pandemic sell-off, and we went back to where we were in February of 2020, we're up 100% since then. And forward earnings are up 100% since then. So it's been actually an earnings-led market with a multiple of around 22.
Ed, your line, our concern is that lowering interest rates will lead to financial instability. What might that instability look like then?
Well, we're just talking about a plain old vanilla melt-up. 2022 is a very elevated valuation multiple. It can be justified by the fact that the economy is growing. It can be justified by the fact that the Magnificent Seven account for 30% of the S&P 500, and they have a multiple of about 30 right now. And the rest of the market's got a valuation multiple of 19. Not cheap, but that's it's the impressive 493. They're doing pretty well. It's just by comparison to the Magnificent Seven, they look a little punky. But all in all, I think we're still looking at a bull market that continues to maybe 6,600, 6,800 by the end of the year, and 7,700 or higher by the end of next year.
Ed, a melt-up doesn't sound so scary. In fact, Max Kettner would absolutely embrace it and say, let's go. Just like you said, you actually see bigger returns. Where is the pain then? Where is the negative consequence if the Fed doesn't need to cut? Does it come with higher long-end yields that we just aren't seeing yet?
Well, I think as I said in the quote you picked up, we don't really need a rate cut here. And if we get a rate cut, that increases the odds of a melt-up. So whatever targets I gave you, we'd surpass them sooner rather than later. And then the valuation multiple is suddenly at 25. 25 is where the tech bubble burst back in the late 1990s, early 2000. We don't want to go there. And I think what really is important to understand here is that cutting interest rates isn't necessarily, all that liquidity is not necessarily going to go and create more jobs. I think we've lost 1.5 million people in the labor force who are foreign born since since March of this year. So obviously the shutting off of the border and the elevated deportations have reduced the supply of labor. And that's not going to change if the Fed cuts interest rates. And by the way, the job openings have been declining in areas that benefited from the inflow of migrants, and that was state and local government job openings really have declined sharply because we don't need as many teachers, we don't need as many social workers, and that's where some of the job losses have been, and that's not going to change just because the Fed lowers interest rates, but we could get more inflation out of it in terms of consumer prices, and we could get higher asset prices, which is fine unless it's a melt-up.
So, Ed, what do you think when you take a look at some of these consumer surveys that show that individuals in the United States think that it's the hardest time to get a new job going back to at least 2013? This idea that you do see a real sense of deterioration in consumer confidence about the labor market. Does that raise alarm bells, or are you saying that this is a structural sea change that cannot be affected by monetary policy?
Well, if we kind of drill down and look at the labor market report that came out recently, what we know is that where it is very hard getting harder and harder to get a job is for teenagers and would-be workers who are 20 to 24, mostly people who are coming out of college. So entry-level jobs have become more difficult to obtain. Some of that may be related to productivity. Some of those younger people, you have, a lot of people cross the border, and they weren't old people; they were mostly young people, and they're going back. So I think that's an issue. But for anybody above 25, not anybody, but for people in that category above 25, the unemployment rates are below 4%. They've been there for a while. That hasn't really changed. So it's a very bifurcated labor market.
Ed, when it comes to what's going on in the stock market, though, you have all these tech companies spending a ton on CapEx. That doesn't mean when it comes to these data centers that it's actually creating new jobs. So can we see a melt up in the stock market, but a recession in the real economy?
Well, I think the economy is evolving very rapidly into something different than we're used to. I think we're still kind of looking at the old-fashioned business cycle model where manufacturing of goods is important. That's the case, and everybody recognizes the services have become bigger. But I think people still haven't wrapped their arms around the fact that we've been in a digital revolution that actually started in the mid-1960s with the IBM mainframes. And here we are now with artificial intelligence. And this revolution is all about processing more and more data faster and faster, more cheaply. And that's what AI is doing. That's what the cloud is doing. And that's a whole new economy. And it has tremendous implications for the future. I've called this the roaring 2020s, and I think it could go into the roaring 2030s because of this digital revolution that we're in that seems to be actually accelerating.
So, Ed, you went there. I'm worried about the 30s, so you help me. This is the situation at the moment. A lot of the gains are concentrated in asset price appreciation. The labour market's weakening. You've got the far left waiting in the wings, making a pitch to this country that they should be running things. And if we see gains in the stock market, but not gains in the real economy, I think capital gains is going to be a big story in the next 10 years. Ed, why should we be optimistic and constructive for capital markets in the 2030s, given the dynamics that are starting to build already?
In a word, productivity. So, for example, today we may very well see that the Bureau of Labor Statistics lowers the level of employment over the past year or so, at least on a preliminary basis, by 450,000 to 750,000 jobs. And everybody's going to interpret that as being a sign that the labor market was actually weaker than we thought. Actually, I think it indicates that productivity is increasing. So what we sort of lose on the headcount side, we gain on the productivity side. And if that's the case, then real wages go up. So all the workers that are out there are going to, on balance, on average, get an increase in their inflation-adjusted wages. And that's where the growth in real incomes are going to be. And that's where the growth in consumption is going to be fueled. And then we've got capital spending, particularly in technology. It accounts for over 50%. Technology accounts for over 50% of capital spending now. That's only going to go higher. And so, again, I think the economy's nature has changed pretty dramatically. I think the stock market has figured it out. And I think it's all good if I'm right about the productivity story.
Ed, I hope you're right. Only you could get us talking about the 2030s. Ed Yardeni, if you had any research. Ed, thank you, sir. On a bullish view, not just for now, but well into the future.
Yeah, what he's talking about is actually fascinating. This idea of companies being able to do more with less as being a feature, not a bug, and actually being the fuel to get the United States into another decade of double-digit gains on the S&P. 7,700 is sort of the low-ball base case for him for the end of 2026. So this is where we're at right now.
What do you make of the bull case going into year-end? Never mind the 2030s. The bull case into year-end, that we're underestimating just how hard this Federal Reserve is going to run things.
That, to me, comes with the potential risk of what he said, which is getting there too quickly and then getting some steam blown out from it. The idea that it's asset price inflation without any benefit to the underlying economy. There are a number of people who would disagree with that, but there are a number of people who do agree with that. Max Kettner might be one of them, but you might as well ride it while it's hot. And that, I think, is what a lot of people are saying.
The price of gold speaks for itself, up 39% so far year to date. Up 39%. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahira. Hey, Yahira.
Hi, John. The Bureau of Labor Statistics will release revised job figures at 10 a.m. Eastern. The data is expected to show U.S. companies hired far fewer workers than initially reported. The estimate in Bloomberg survey calls for a downward revision of 700,000 jobs, as many economists expect the labor market to show further weakness. Meanwhile, House Democrats released an alleged birthday note from President Donald Trump to convicted sex offender, the late Jeffrey Epstein. The note includes the sign-off, "May every day be another wonderful secret," complete with the sketched outline of a woman's body, which you can see behind me. Trump has denied composing the message or that the note existed. And in M&A news, Anglo American has agreed to acquire Canada's tech resources in a zero-premium transaction, marking one of the biggest ever mining deals. The deal gives Anglo access to Teck's much-coveted portfolio of copper mines, and if approved by regulators, the acquisition is expected to be completed in 12 to 18 months. That's your Bloomberg Brief. John?
Yahira, thank you. More from Yahira in about 30 minutes' time. Up next on the program, rising tensions with South Korea.
Many of those individuals that were detained through that operation in Georgia, we are following the law. They are going to be deported. A few of those had criminal activity beyond just being here past final removal orders, and they will face the consequences for that.
That conversation up next with Henrietta Trays of Theta Partners, live from New York City this morning. Good morning. Remember when this used to be the biggest event on the planet? Like there was nothing else. Apple was coming out with a new phone. 1 p.m. Eastern time. It's the first time we've mentioned it all morning.
Yeah, the expectations are pretty low. Performance of the stock has been fairly low. It typically sells off after the event. They might announce some small, thinner phone that could potentially be foldable at some point in the future. But unless they announce sort of a self-driving aircraft, it's hard to see what's going to get people particularly excited.
That big unveiling that everyone's excited for comes a little bit later on this afternoon. And the surveillance this morning, I'm not. Rising tensions with South Korea.
People that are in this country illegally need to know right now today that they have an opportunity to go home before they are detained. So many of those individuals that were detained through that operation in Georgia, we are following the law. They are going to be deported. A few of those had criminal activity beyond just being here past final removal orders, and they will face the consequences for that.
So here's the latest this morning. South Korea's top diplomat arriving in Washington today. The foreign minister looking to secure the release of about 300 detained workers after an immigration raid at a Hyundai EV plant. Bloomberg's Tyler Kendall joins us now for more. Tyler, welcome back to the program. Have we got some clarity on just what rules were broken here?
John, at this point, it's unclear. A person familiar does tell Bloomberg News that the majority of these workers were skilled equipment engineers and that most of them did have visas. But at this point, it's not totally clear exactly which visas they did have. And the administration has said at this point that this came after a months-long investigation into the plant and that it appears that they were breaking labor laws in the U.S. But really, we know that this is part of this broader immigration push from the White House to curb what they say is illegal immigration. We're still waiting on how this is all going to shake out. You mentioned that the foreign minister is going to be here to try to secure a deal, and Bloomberg News is reporting that at this point, they're planning to send a chartered plane from South Korea to Atlanta, which would bring home those 300 detained workers.
Tyler, with the latest, thank you. I want to bring in Henrietta Schrays of Veda Partners. Henrietta, I just want to stick on these pictures. And I want your perspective on how these kind of pictures play out in places like South Korea, when their government is getting together and negotiating with Washington to come up with $350 billion investment deals. What do the people of these countries think?
Well, I think the first question that it always needs to be is what are the political ramifications of continuing to side with the United States when they're, trying to forcefully kick out 300 skilled laborers, and that's what it is. So South Korea is doing exactly what President Trump has asked for, investing $350 billion in the United States across these Hyundai plants, electric vehicle plants, et cetera. And then you're simultaneously kicking out the very employees that they need to run said plant. So it's a thumb in the eye across the board. I think it really gets to the heart of the matter that these trade deals the president has announced with various nations, including the EU, Japan, South Korea, none of them have legal text. None of them are finalized. And pending the Supreme Court ruling on IEEPA, I anticipate that most of them are going to get upended in the next couple of weeks anyway. So basically, we do not have a deal with South Korea. We do not have a free trade agreement. Tariffs are exponentially higher than they were when Trump took office. And we had a congressionally passed 0% tariff rate on like 95% of goods coming in from South Korea before this administration took office. So I don't see any material good news here.
And local press in South Korea is saying at the same time the U.S. and South Korea are holding working level talks when it comes to the trade deal. But how can what's happening at Hyundai and this plant impact those negotiations?
Well, I think the issue, as we're seeing in countries across the world now, is that their political leaders cannot enter into binding agreements with the United States for their own domestic political purposes. So it really just is that, thumb in the eye situation that creates an impossible, intractable path for the United States and these nations to come to an agreement. And their political leaders can't have it, just like Trump can't have it.
Does it mean that potentially the United States won't get this $350 billion worth of investments from Seoul?
Absolutely. No question.
So where does this leave the trading relationship?
I don't think that there is a trade deal, and we've already undermined the free trade agreement and overridden it with the IEEPA tariffs. So we have these tacit commitments on things like sectoral tariffs for 232s on pharma, on semis. A critical one for South Korea is one that hasn't emerged yet. That's the lumber and timber tariffs, which President Trump tweeted about being the furniture tariffs a few weeks back. Those are directly targeted at South Korea and Canada. So I don't see an opportunity for this trade deal that they have that allows South Korea to commit to this IEEPA rate holding water and certainly that $350 billion in investment materializing when South Korea can't put its own skilled laborers that the United States does not have in plants in purple states like Georgia. It's unsustainable.
Henrietta, does this Georgia situation tell us anything about what a bigger priority is for Trump domestically, whether it's limiting immigration or whether it's getting these trade deals done?
Yeah, I think that's fair. Immigration is one where we can say, objectively, the president has succeeded beyond all of his measures, even so much to say that he did it too fast. And now they're targeting these areas where it's job creation and hitting the trade agenda and the investment that he said he wants to see in the United States. But as I mentioned at the outset, these trade deals that we have reached with the EU, with Japan, with South Korea, Vietnam, the Philippines, Indonesia, they do not exist in legal text. And the fundamental underpinning is the 15 to 60% IEEPA tariffs that are in effect across these deals that the president indicates he got these nations to agree with. When the Supreme Court rules that they're unconstitutional, which is something that is entirely possible, we'll get an announcement about when they're going to take up the case as early as today or tomorrow, then you really have the question of what matters more, the immigration stuff that we've delivered on or the trade deals that don't exist.
And one thing that we were talking about yesterday is it seems like these goals are in conflict. The idea of limiting immigration while also getting certain investments and getting certain trade deals across. I'm wondering if this really speaks to how this is being perceived politically, whether trade deals are complicated politically, but limiting immigration caters to a certain base of President Trump that he will continue to double down on and will come at the behest of whatever trade deals might get through. I'm just speculating. I'm wondering if that's a message or if this is a little bit messier than being stated.
I would say let's go straight to the numbers. Because I totally agree with you. Where is the American public on this? The stock market is reacting in one way to all these tariffs. But the American public, and I've said this to y'all for a while, and the polling continues to support it, this is a 60-40 issue, a 70-30 issue that the president is on the wrong side of. 77% of Americans believe inflation is the number one problem. As an overall scale of what their most important issue is, all voters, Democrats, Republicans, and independents, predominantly independents, believe that inflation and high prices are the problem, and they think the president has gone too far. That's the exact Economist YouGov wording of their polling on tariffs. And that's a 54% number as of the latest data. So American voters are incredibly aware of the fact that tariffs are taxes, prices are higher at grocery stores and at big box retailers, and they do not like it. And that's why you're seeing the president's approval rating so far underwater. So you can get distracted with some of the other components. And of course, there's a healthy population of Americans who very much support the president's immigration agenda. But the economy wins all day, every day. And inflation and prices continue to be their number one issue, and they don't like the tariffs.
Henrietta, appreciate your take as always. Henrietta Trays there of Vader Partners. Speaking of inflation, tomorrow PPI, the day after CPI. Inflation, a big focus for us this week. Next on the programme, Amy Wu Silverman of RBC and why the VIX may not be following the seasonal playbook. Waking up Tuesday morning, looking at record highs on the Nasdaq 100 once again. Very, very close to them at the close yesterday, and the S&P 500 within just 0.1% from another record. This morning, just about unchanged on the S&P, just about positive on the Nasdaq 100. What a change in this bond market. When the Fed last met, the two-year yield was pushing 4%. On the day of that meeting, in the mid-390s. This morning, 350. 350.88, yields up by, let's call it 2 basis points. But a week out from a Federal Reserve meeting, and we've seen a major move lower in bond yields.
Investors pricing in a Fed that has to cut, will cut, and might be able to cut even more next year as a result of a labor market that's weakening. The big debate is this an indictment of the risk asset rally that we've seen? Or does this just support it? Because ultimately, any rate cuts, whether they're warranted or not, will only continue to fuel some of the positive sentiment around risk assets.
Said a few times, the good news coming from the long end of the curve, the fact that the 30-year yield has actually moved lower. Last week, threatening 5%. All the fear about that this morning. Let's say 470 on a 30-year bond yield. I think the lowest since late April, early May.
This is BLS revisions week. It is not CPI week. And that tells you everything you need to know. People are not focused on inflation that's going to be coming out on Thursday and what that does to any kind of Fed rate decision. They are focused on just how weak the labor market is and how much more that could justify later. And that tells you where the pulse has gone.
Also makes you wonder just how balanced the risks are going into Thursday. We can get to that in a moment. 2 hours away from the opening bell. The opening bell at 9:30 Eastern Time. It's 7:30 here in New York. Let's get you some morning movers with Danny Berger. Hey, Danny.
Hey, John. It's the big deal of the morning. It is Anglo-American buying tech resources, the Canadian company listed here in the U.S. Shares rallying 17%. That's exactly bang on the premium that Anglo will be paying for. And they're paying, let's not get it mixed up, they're paying for their copper assets which have been very sought after by other mining companies. This creates a behemoth, one of the biggest mining deals, about $50 billion between the two. Elsewhere, we are looking at CoreWeave shares moving higher in the pre-market, just under 6%. They have announced they're launching something called CoreWeave Ventures. It's essentially a platform for entrepreneurs trying to build AI platforms and AI businesses. They'll provide some of the resources. I guess the thinking and the benefit for CoreWeave is they get access to some of that AI technology. You talk about that and share prices go higher. Moving lower this morning are shares of Fox Corp. It is the succession drama finally settled. It is a Fox that will now be under the control of Lachlan. That has been decided with the Murdoch empire. Meanwhile, the other Murdoch kids will be selling their shares. So it's a dilutive event, the three of them, and maybe that's why you're seeing shares move lower off the back of that, down 4.7%, John.
Danny, thanks for the update. Appreciate it. More from Danny in the next hour. On our radar this morning, we're looking for some big revisions to BLS employment data at 10 a.m. Eastern Time. The estimate in Bloomberg survey calling for a downward revision of about 700,000 jobs. Elsewhere, the Senate Banking Committee voting tomorrow on the confirmation of President Trump's Fed pick Stephen Myron. The move likely setting up Myron to be confirmed on the Board of Governors before next week's FOMC meeting.
Does this matter from any kind of tangible Fed policy perspective, or does this just matter on a visuals perspective? What everyone wants to see, Stephen Myron walking in and the reaction of coolness from everybody else. Is there some kind of, Mean Girls drama? Is this just ultimately optics, or is this actually substantively going to change any kind of perception or policy making on the Federal Reserve?
Well, he gets a vote. Right. So he's going to get a vote when he steps in, and he's going to clearly get through the Senate Banking Committee. And then he didn't lose a single Republican vote in March when he was ascended to the CEA. So he's likely going to get all the votes he needs when it comes to the Senate. The question I have is, what are members of the FOMC, maybe these mean girls who can't sit with us, think about him basically keeping one foot in the White House, taking this leave of absence at his current position, at his job under President Trump?
Is he going to push for 50 basis points if he sat around that table? And will he have some company in people like Governor Waller? Governor Waller open-minded about that going into the recent employment report, and the recent employment report wasn't good at all.
Yeah, if you end up with Mickey Bowman and Chris Waller actually supporting the idea of a 50 basis point rate cut, remember they dissented at the last meeting, how much does that change the conversation in a material way? I want to just set the record straight. I actually don't think the Fed is full of mean girls. I think it's going to be kill them with niceness. They might talk about it behind people's backs, but I don't get the sense that it really is that kind of vibe.
They're a nice bunch of people.
I think that
welcome
there isn't.
breakfast.
Well, I don't think it's going to have that kind of vibe of don't sit with us. They might think that, but I don't. That's just my gut.
Struggling to think of someone on that committee that would be mean. I can't think of anyone,
right?
To be honest with you.
I don't see
style.
it. No, it just doesn't seem to be it.
No.
Okay, glad we settled that.
Beth Hammock sort of throwing things
you
because she's a hawk. I don't see that either.
Coming in with a beak.
That's not their vibe.
All right, let's move on.
At all. All right. Apple holding its annual product launch event today. The highlight expected to be the iPhone 17 Air. The phone getting criticism over its shorter battery life and single rear camera.
Do you want a phone that folds? I'm serious. Is that really important to you?
There's a new trend. Flip phones, Nokias, are coming back in style because there's college students, there's children in school and high school that are saying they don't want to keep doom scrolling and feeling the need that they always need to be online. So what's old is apparently very cool again.
Have you seen the Google commercial? No. I think the language in that is great. I'll share the quote with you. If you buy a new phone because of a feature that's coming soon, but it's been coming soon for a full year, you could change your definition of soon, or you could change your phone. I think that's such a great message.
If you want Mean Girls, go to Google and Apple, evidently, not the Federal Reserve, because that's some pretty serious boxing gloves. The boxing gloves are coming out, and I think that is exactly the point, which is Apple has competition in a real way for the first time in a long time. Can they really turn the tide back to themselves? The bar is so high that the expectations are very low heading into this meeting.
We'll come back to this story in about 40 minutes' time. We'll catch up with Walt Piecyk on what you can expect later on this afternoon in Cupertino, California. Let's turn back to financial markets. Stocks trading near record highs. Amy Silverman of RBC saying the following: while seasonally the market gets these September scaries, it is important to note that since the summer, VIX has not been following the seasonal playbook. Amy joins us now for more. Amy, good morning.
Good morning.
We'll try and make this very simple. So typically, when you're really worried about lots and lots of things, you see a VIX above 15. I think a lot of people are still worried about lots and lots of things, and the VIX is at 15. Can you help explain that for people? Why is that happening?
This is, I would say, one of the most common questions I get. So I've had to bring back my paddling duck analogy. Just, it looks calm and smooth on the surface, right? But those little duck feet continue to furiously paddle underneath. And that compression we see is not evident until you dig deeper. So when you look at single stock option prices, when you look at rotations, there are multi-standard deviation moves, but you don't see that in the headline VIX. And beyond that, everyone keeps talking about the September scaries. They talked about August being the inflection point for both VIX and spot returns, but we haven't seen that play out this year, and it's not necessarily the case you're going to get it for September and October either.
Do you think people have been conditioned by some of the recent outperformance that we've seen? That risk goes to both the downside and the upside, and that maybe there's just this ultimate sticky feeling of that we've missed out, we keep missing out, we can't keep missing out?
I think that is 100% it. So I think of kind of post-COVID as its own volatility regime. And the reason is when you look at the distribution of tails, so your left tails being the scary bad things that can happen in the market and the right tails being that chase up, most investors I talk to, they've been hurt by the knife up more than the knife down. And so, you think about the anchoring to the most recent risk. It was April 2nd where they got caught offsides on the way up. They were protected on the way down, John. They were caught offsides on the way up. I think that's why the right tail is still in everyone's mind.
Do you see more volatility getting priced into specific sectors, to specific company stocks? The idea of it's too difficult to sort of put the whole market together and make some sort of cohesive bet based on how much macro uncertainty there is. So I'm going to bet just on this sector. I'm going to bet on this stock. Do you see that in a more significant way?
We really do. And so part of the problem is if you take something like VIX, which is just S&P, 1 month implieds, that kind of gets canceled out because if you see more on one sector and less on the other, you're not seeing that again on that duck floating on the surface, but it is happening. One thing I'll say that's interesting is despite the concentration risk in the market, you're not overly seeing it in Mag 7. So you see it when we kind of look through all the sectors, we compare those pairs of volatility. You may see it in healthcare, you may see it in some of the sectors that are more tariff related. You don't see it yet in the heavily concentrated Mag 7. And we know how the meat is made, right, Lisa? It's made by Mag 7 and that's not showing up in S&P.
This is one reason why a lot of people, in particular, John's been picking up on the cyclical tilt to the recent rally, the idea that small caps have been benefiting from this idea that the labor market's weak. Somehow that's a positive for small caps, but that actually does mean the beginning of another cycle because of rate cuts. And it sort of is this conundrum baked in an enigma, baked in a riddle. And I wonder if you're seeing people taking the other side of that. The idea that cyclicals don't have that much more room to run if the labor market truly is as weak as maybe some people are suggesting.
So I will tell you that the one thing we have seen, and we use IWM and S&P basically as proxies. So IWM is your small cap to mid cap proxy versus S&P, your more Mag 7 concentrated. That spread is really wide. It is telling you that people are trying to place these bets through the options market. I will tell you that I kind of remain more, boy who cried small cap. I'm a little bit skeptical because I've seen this movie a lot of times. It's had fits and starts, but it doesn't go all the way through. And one of the reasons is you don't need to participate in a rally in small and mid cap the way you do if S&P knifes up because of Mag 7. There is a concentration risk. We call it benchmark FOMO, but it exists because NVIDIA is so much of S&P and you don't have that in IWM. So again, that right tail, going back to that knife up risk, it doesn't exist as much in positioning dynamics.
Could we pick up on the knife up risk, what happened, the melt up basically after Liberation Day? Are investors pricing in taco enough?
I don't think so. It's kind of interesting. So I think that there was kind of this tantrum when Trump was discussing the idea of firing Powell. But then you essentially saw it less and less when we start talking about Cook, I feel like the market kind of priced a certain level. The thing I think is interesting in terms of the taco is what we learned is basically there are guardrails to the market. I think there was this debate in April of whether or not there were. There were. I think it was multi-standard deviations below what the market had expected. But it does exist, and I don't see why that wouldn't be true on a carry-forward basis when it comes to Fed independence or BLS or any number of things.
We spent hours every single morning talking about the Trump put and whether it existed anymore in the equity market. That moment you had on Air Force One with the president asking about equity markets and how angry he got over the issue.
Yeah, he said it was a stupid question because he doesn't want anything to go down, but it said that the economy at some point may need medicine. I think what we learned is that Trump really does have a tremendous amount of patience and can really bite his tongue while the market is going down. But at the end of the day, there is a line in the sand for him.
Amy, any recommendations going into year end? What's the conviction call for you and the team?
I think one thing that sets up as reasonable and attractive, again, if you think we're not necessarily going to get the playbook and we're worried about that knife up, is just short-term NASDAQ or S&P calls because they're relatively inexpensive right now. And again, there's much more benchmark FOMO going up than there has been down since Liberation Day.
Interesting. Amy, enjoyed this. It's good to see you. As always, thank you. Amy Silverman there of RBC Capital. If you're just joining us, welcome to the programme. Equity futures just about positive on the S&P 500. Let's get you an update on stories worldwide with your Bloomberg brief. Here's Yahara. Hey, Yahara.
Hi, John. Supreme Court Chief Justice John Roberts let President Donald Trump temporarily oust a Democratic member of the FTC. The decision signals that the court is likely to back Trump's bid to assert control over the independent agency. Roberts set a deadline for next week for Rebecca Kelly Slaughter's lawyers to respond. Meanwhile, a former Meta employee is suing the social media giant, alleging WhatsApp contained, quote, systemic cybersecurity failures. The former head of security alleged Meta retaliated against him after he notified leaders, including CEO Mark Zuckerberg, of the security issues. Meta is disputing the allegations. And Monday Night Football kicked off last night. The Minnesota Vikings defeated the Chicago Bears 27-24 to wrap up week 1 of the NFL season. Vikings quarterback J.J. McCarthy accounted for 3 touchdowns in his long-awaited debut and helped lead his team to a fourth-quarter comeback victory. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. Up next on the programme, inflation in focus.
If you get a really bad print on inflation this week, then I think the long end could easily go up. And if the labor market continues to weaken and inflation isn't quite as bad, the entire curve could fall, just the long end less than the front end.
That conversation up next with Amanda Liner of BlackRock, live from New York City. You're watching Bloomberg TV. Stocks are positive by 0.1% on the S&P, higher by 0.2 on the NASDAQ. The main event in the commodity market, gold, 36.52, up for 10 of the last 11 sessions, I think. All-time highs, and this morning up another 0.5.
Is this the fly in the ointment for the story that maybe you could have a Fed cutting for the wrong or for the right reasons and have a market that just keeps chugging along? Is this a sign that people are getting worried about what that could do to the dollar and the long end of the yield curve as people continue to go into gold for a haven trade?
Keeps coming back to that bull case. Just how hot is this Fed willing to run things? This has been a story all year. All year. And also, I think another leg to this, if you really want to get into the doomsday story type stuff, if you believe the Fed's going to come in and be taken over as an institution, it's a fringe view, but if you believe that, they come in and they're just going to buy loads and loads of bonds and you're going to get fiscal dominance come through, then the way to play it is to short the dollar. Against what? Against what? The euro? The yen? I don't know about that. Sterling? No, thank you. You're going to play it through precious metals and gold.
And this is the actual secular story you're seeing play out with central banks around the world, in particular China, which is reportedly buying a significantly greater amount of gold than they are reporting at any given time. So a huge source of demand as people look to diversify away from the dollar.
We've seen some of that, some fringe views, some contrarian bets. And look, whatever you think is the reason gold is going up. And the chart's been up and to the right for a number of years. Under surveillance this morning, inflation in focus.
If you get a really bad print on inflation this week, then I think the long end could easily easily go up. And if the labor market continues to weaken and inflation isn't quite as bad, the entire curve could fall, just the long end less than the front end. I think some of the risks have sort of transferred more to labor. But remember, you're going to lose top line growth as well as inflation does go up and consumers start to pull back.
So here's the latest this morning. Investors looking ahead to a double dose of inflation data before the FOMC meeting next week. Amanda Lynham of BlackRock writing, we anticipate the Fed's rate cutting cycle will ultimately resemble normalization cuts to lessen the degree of the restrictive stance. Amanda joins us now for more. Amanda, good morning.
Good morning. Thank you for having me.
I want to lean on something you've been talking about. It's the growth inflation mix. It's been souring through summer. Do you expect it to get better through the rest of the year?
I think through the rest of the year, no, but into 2026, maybe there's some potential for a recovery. I've been really positively surprised by the commentary from management teams in the second quarter earnings season. They're pointing to a myriad of operational levers to help them navigate this uncertainty. If you couple that with some easing in financial conditions that we do expect from rate cuts that will probably materialize starting in September, coupled with some of the fiscal impulse, I think that does set up for a more constructive stance, at least, or not least of which because some of the uncertainty has also been lowered. So I think the key message that we're advocating for investors is there's an opportunity cost to being too defensive in this market. I think in your question, it's notable that the risk asset move is actually different from the economic backdrop, right? So there's a bit of an economic hoverang into the rest of the year, but actually we're pretty constructive on risk assets, and actually December is quite a favorable month seasonally for corporate credit.
So which is the bigger risk? I mean, as Annmarie is doom scrolling over here, she talks about a risk of potentially a deterioration in the labor market that Neil Dutta calls a recession potentially down the line. And then on the flip side, you have a Fed that's cutting when they don't have to, and you see runaway inflation and everyone buying gold like John. So at which point, which fear is the most overstated?
So I would say we're very respectful of the softening in the labor market that has been materializing. The Fed views its current stance as modestly restrictive. There's not as much cushion for them to cut, for example, by 50 basis points in our view, like they did in September of last year, because they're just starting from a lower point. I think the way that we view this is that the Fed really wants to get ahead of a material kind of nonlinear deterioration in the labor market. Do they have to cut rates? If you look at a variety of risk assets, it would tell you no, but there are pockets of corporate credit, of consumer credit, that would actually welcome some lessening of the degree of restriction. I think if I had to boil it down, it really is the growth backdrop in the labor market that I think is the more pressing concern at this point. I was surprised that Chair Powell noted that in Jackson Hole that one time doesn't mean all at once on the inflation pass-through. And so it almost seems like they're bracing for this kind of rolling impact of inflation, which I think is a tone shift from the Fed.
Do you think that Thursday matters at all, CPI?
I do. I think it matters, but I think the bar for the market to allow it to derail what they believe is the forward path of monetary policy is also very high. So really, the commentary from companies is that they have a myriad of navigating tools to go through this dynamic, this uncertainty. In some instances, they're taking price. In some instances, they're not. So I think, yes, we have an eye on the inflation data, but the one data point is not going to, I think, derail a path. It would need to be a consistent pattern of kind of second round effects of inflation.
But what kind of print could we see that you think actually does get Jay Powell's attention?
Well, I mean, I think obviously goods are in focus. From the perspective of the Fed, I think they're bracing for some upward pressure on inflation. I mean, they've been almost kind of looking at something above the 3% range as in terms of a possibility. But I actually think it's more in kind of the second round effects. Does it cause an increase in wage inflation? Do we have kind of labor shortages that are causing upward pressure on services? It seems like the goods is baked in, but the services is more of an issue. But I don't think we're going to get that answer, Annmarie, on Thursday. I think that's a longer term trend.
I'm so pleased you mentioned that one line from Chairman Powell's speech, because I actually think that's the most important line for the next maybe 6 months. The chairman is basically setting themselves up to ignore hot inflation prints for the next several months. Doesn't that make this setup for markets pretty bullish?
Yes, but it's also part of the reason why we're expecting steeper interest rate curves, right? So I do think there are some trade-offs. But yes, in terms of the lessening the degree of restriction is a welcome development for corporate credit, especially when they're not doing it in response to a significant deterioration.
Let's just sit on that for a beat, if I can, just to explain it a little bit more. So when we go into a hot inflation print, it's not going to reduce the amount of interest rate cuts because we understand through the Fed's reaction function articulated by Chairman Powell in Jackson Hole, that's not going to disrupt things, but you're going to see it further out along the curve.
I think so, and I think that's what you have been seeing episodically. We've backed away, for example, the 30-year from that 5% level. We're closer to 4.7 as of this morning. But I do think we are expecting volatility in long-end rates. That's not specific to the U.S., by the way. That's a global phenomenon. That coupled with some of the fiscal overhang, I think you expect steeper curves.
What's going to drive risk appetite, the front end or the long end?
I think yields across the board have been driving risk appetite, and you can see it. Look no further than the new issue market in this week. Actually, new issue concessions are very modest. Volumes are very heavy. Yields are actually backing away from the peaks. Investor demand has been insatiable, right? So we've seen very modest new issue concessions and a lot of appetite for that risk. And so I think it's the yield backdrop across the curve that remains pretty attractive by historical levels.
Such an interesting moment. Yeah. This setup. Financial markets are not demanding rate reductions, right, but the labour market's like screaming for them, based on the revisions we'll see again later this morning.
Yeah, and this really comes at a moment when the U.S. government could get penalized in terms of long-term borrowing costs, but companies could have a very robust funding backdrop, especially because people might prefer owning them for a little more yields than just owning the straight government bonds that are seen maybe as less creditworthy.
Can I ask you the chicken or the egg question? Yes. And forgive me for asking it. Are financial markets doing well because we're anticipating rate cuts? Or are they doing well because it's anticipating a recovery?
I think financial markets are doing well because corporates have been very forthcoming about all of the operational tools at their disposal. I think actually it's because we've had above trend growth for 2023 and 2024, and perhaps the market underestimated the degree of cushion that was actually embedded in financial in corporate balance sheets.
Amanda, appreciate it. As always, thank you. Amanda Lynham of BlackRock on a very resilient corporate America.
Yeah, you know, Amanda is reflecting what I hear from other corporate executives across the board. They're surprised at how decent things have been, and that even though there's been a lot of headline risk, they haven't seen it in their underlying businesses to the same degree that they had expected. You hear that again and again and again, and then they lay out why they can reduce prices on something that's tied to oil prices, but can increase prices on something that's tied to something more tangible.
Max Kettner, HSBC, first guest out of the gate early on this morning, basically said to us, don't anchor your view on the equity market around payrolls growth. Anchor your view around the equity market, around what's happening with corporate earnings and corporate America. And that's been the tale for him.
You and I both agree, and Annmarie, I know you do too, that this dissonance can't go on forever.
Something's got to give.
Something's got to give. And that, I think, is really
also,
the key
if you're sitting in the White House, you can't just say the economy's doing well because we just hit another all-time high when people are losing their jobs.
I saw that with Biden. Doesn't work too well.
No.
You don't want to repeat that act, that's for sure. Up next on the programme, Emily Rowland of John Hancock, Walt Piecyk of Lightshed Partners, James Egelhoff of BNP, and we'll catch up with Gershon Distenfeld of AllianceBernstein. From New York City, this is Bloomberg.
The bond market has this confidence that the Fed is going to stick to its 2% inflation target.
If you get a really bad print on inflation this week, then I think the long end could easily go up.
We are expecting the Fed to cut rates.
If the Fed wants to cut rates to stimulate an economy with no excess capacity, they're just going to create more inflation.
We think inflation, lingers a little higher.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The opening bell about 90 minutes away. This is the third hour of Bloomberg Surveillance, and it starts right now, live from New York City this morning. Good morning. Your scores look like this in equity markets. Financial markets firmer by 0.1% on the S&P, up by 0.2 on the Nasdaq 100. In the bond market, yields a little bit higher by 2 or 3 basis points across the curve, just north of 350 after settling down sub 350 in yesterday's session, 351.91 this morning. The economic data you're looking for comes at 10 a.m. Eastern time. It's about 2 hours away. You'll get those benchmark revisions to payrolls growth over the previous year through the month of March. And then later, an event that used to be the event and no longer. Apple iPhone, a new one at 1 p.m. Eastern time. And it just feels like such a dud over and over again.
Expectations are pretty low. It also used to be that Apple shares would rally significantly in the 6 months ahead of their conference where they released some new products. There's not a lot of anticipation. The shares have lagged behind the other Magnificent Seven names. There's a real question of how big of an innovation would they need in order to restart the dynamism around the name. You raised the point of Google and the tongue-in-cheek advertisement against Apple, and I think that's exactly the right point. There are competitors, and they're coming after Apple in a new way. How do they fend those off? and how much they have to really innovate in another kind of direction.
And when it comes to Apple, the setup is they're going to unveil this new iPhone that people are not really that excited about. At the same time, will they price hike on these iPhones? Will there be a price hike because they are dealing with things like tariffs as well? But you're raising the price for a phone that people maybe don't even want.
How long has Dan Ives of Wedbush been coming on this program and talking about the upgrade super cycle? We've been talking about that forever. And again and again and again, every year, there's not a phone that I believe personally is worth upgrading to. So now I think we get to the more important question. What would it take for that existing base to believe I'm going to go somewhere else? Because that's the most important question now for competitors. You've got to the point where people are upgrading. The upgrading super cycles just never come around. It's always been like the bullish view. It's not happening. What would it take to actually get people to move away from the Apple ecosystem? How close are we to that moment?
And how much does this really hinge on artificial intelligence, the development that's been elsewhere, and not necessarily with Apple? We've seen a lot of their AI-related staff poached by the likes of Meta, and I do wonder whether Google and some of that rhetoric that you were reading, the idea of maybe if everyone's hoping that this new launch will be it and it's always going to happen and it never happens, maybe you're looking at the wrong place. Where else would you look? Something that can make your lunch, make your dinner, tell you how good you look that day.
A humanoid robot.
In the shape of a thin phone. I don't think so.
Yeah, leave your house.
That launch in Cupertino, California, coming later on this afternoon. We'll have full coverage on the ground of that event from the Bloomberg technology team. Coming up this hour, we'll catch up with Emily Rowland of John Hancock Investment Management as stocks trade near all-time highs. Walt Piecyk of Lightshed Partners as Apple is set for its latest product unveiling. And James Egelhoff of BNP Paribas as he's raising his bets on rate cuts. We begin this hour with stocks edging higher ahead of key economic data. Emily Rowland of John Hancock Investment Management writing, risk assets may be overly confident that rate cuts will be able to mitigate the associated economic risks with a weakening jobs market. Emily joins us now for more. Emily, welcome. You don't seem comfortable with stocks at all-time highs.
No, John, we think it's right that the bond market has seen yields come down and reprice for 3 rate cuts this year, but equity markets are still in this honeymoon phase where the weaker labor market data is enough to ensure that the Fed's going to cut, but not weak enough that the Fed can't sort of get us out of it. And the equity market's on the biggest honeymoon ever. We're trading at 22 times forward earnings with double-digit earnings growth embedded in that number. High-yield bond spreads, an astonishing sub 3%, suggesting that there's really no risk in credit right now. And we think, the honeymoon's probably over when initial jobless claims start to rise, where you see high yield bond spreads start to widen. That we're not seeing that right now, but the best time to reposition portfolios is while you're still sort of like on the beach on your honeymoon. The sun is still shining. So we think sort of fading into these more speculative corners of the market that are still seeing gains and redeploying assets into higher quality areas of the market right now makes a lot of sense.
Before we get to how you'd rotate away from where the market is priced right now, let me just offer you the bull case. It comes from Mike Wilson of Morgan Stanley. Acknowledges there are some risks, could be some bumps along the way into year end, but says this: June is the latest low point for payrolls this cycle. Emily, that line's really important. What if I told you that June was the worst of it? That was the low, and that everything in our future improves from here. Would that be sufficient to stick with things?
I think it's a tough case to make right now, John. Markets are acting like this is Goldilocks labor market data. To us, it's not. Job openings, 7.1 million in July. That is near a post-COVID low. Challenger layoff tallies were up 40% month over month and 13% year over year. And companies are telling us that they have the least amount of hiring plans since 2009. Non-farm payrolls, we know a very weak 22,000 with negative numbers from June. Healthcare is driving all of that. Without the healthcare sector, jobs growth would actually be negative. The unemployment rate at 4.3%, that's a post-COVID high as well. So we think that there's actually something more nefarious going on here with the labor market. We would not brush over that. And at the meantime, inflation, yes, it's a little bit sticky right now, but we're seeing major shifts in the housing market right now. Shelters, 35% of CPI. Home prices are down 4 months in a row. Right now, there's a lot more sellers than buyers in this market. So we see all of those things contributing to slower economic growth, worse cracks in the labor market, and the Fed, frankly, here being behind the curve.
How do you square this with corporate sentiment that isn't that bad? And I'm looking, for example, at the Small Business Optimism Index from NFIB that came out earlier this morning that actually went to the highest level since February, with companies talking about how their sales prospects are going up. They're seeing more opportunity to sell into an economy where the consumer doesn't seem all that bad. How does that square with some of the labor market data that we've been getting?
Yeah, it's amazing, Lisa, and it all comes back to the wealth effect. We've had markets up 23 and 24, back-to-back 25+% returns. The S&P 500 is now up 11% year-to-date. And by the way, if you own international stocks, don't even worry if they have earnings or not. Chinese stocks are now the new technical titan of markets. Earnings growth is 0%. Over the past year. European financials up 50%. So portfolios are contributing to this better sentiment. There's more confidence, and consumers are continuing to spend. Until that stops, the consumer can continue to trudge along here. The key, again, is going to be the labor market. We're seeing consumers pulling back because they are concerned about the ability of jobs that are available out there. But right now, if the market keeps going up, there's a huge difference between what's going on Main Street and what's happening on Wall Street right now. And I think that's really fueling a lot of the confidence we've seen across these firms.
And I get a sense that you don't think that can continue, that it has to break at some point, and that the underlying economy will be a leading indicator in some capacity of the business cycle. What is considered a haven in that type of backdrop where you are still on the beach, still on your honeymoon, but looking to be a little bit prepared?
So we're still looking for higher quality parts of the market. And Lisa, the worst performing factors this year have been high quality and low volatility. What's been rewarded is the opposite, low quality and high volatility. In fact, we've seen multiple expansion, just absolutely remarkable across areas like the MSCI EFA Value Index, areas that were once considered cheap. Emerging market equities have seen remarkable multiple expansion as well. There are areas in the United States that are actually still trading at a discount to their 20-year average, small and mid-cap equities in particular. We have a preference for mid over small, given elevated earnings expectations, 17% expected for next year, and they are higher quality. So we're still looking at challenges in small caps as almost 40% of the Russell 2000 index is comprised of unprofitable companies. So we like companies that make money. We're finding that in large caps. The challenge there, of course, is the valuation risk. We're looking to mitigate that valuation risk with higher quality mid-cap stocks. And then, of course, as you know, we're still embracing high quality bonds. Investors are sitting in $7 trillion of cash right now. We think redeploying that cash into a mix of high quality bonds in the intermediate part of the curve still makes a lot of sense here. We don't want investors to miss out on the potential for pretty elevated total return over the remainder of this year and into 2026.
I mean, a lot of people are excited potentially about this rotation when it comes to small caps and mid caps, but how can you have small and mid caps do well if the labor market, to your point, is really weakening?
Yeah, to us, it's not as much of a small cap story. We do like higher quality stocks within small cap indices, but they have higher levels of debt. I think you could see a rally in small cap stocks if rates start to fall pretty precipitously. Maybe we get some, more nefarious employment data and inflation actually misses on the downside. You see yields come down, small caps rally temporarily on that. But mid caps is really where we're finding the quality and the ability to, deal with the fact that the top 10 stocks in the S&P 500 now comprise 40% of the index. We still like U.S. large cap stocks, but that is a serious challenge here. We just think that the U.S. in a way has been sort of left behind as investors have allocated towards international. It's like, the international stocks get like a participation prize right now where the U.S. really needs to earn it. And that's where we think the value is today.
You sound a lot like Neil Dutta when he talks about what's happening and the risk to the economy in terms of the labor market. I'm going to ask you a question I asked Tim. Do you think we're on the edge of a recession?
Shoot, I missed that interview earlier, but we think it's certainly possible. I think again, right now, the idea is that growth is slowly decelerating. We think it's probably decelerating quicker than investors expect. But there's this myopic focus on rate cuts and the ability for the Fed to get us out of it. We certainly hope that's the case. Hope is not the best investment strategy out there. So it's really just about repositioning for that lower growth environment. Equity markets are sort of yawning at the weaker data right now. We think it's time to wake up and sort of think about, preparing portfolios for a weaker growth backdrop.
Emily, appreciate your take. Thank you. Annmarie Hordern there of John Hancock Investment Management. Emily, thank you. I'm right there with you, just tallying up the morning so far. Annmarie Hordern says it's time to wake up. Neil Dutta says we're on the precipice of recession. Then you've got Max Kantner, super bullish. You've got Amanda Lynham of BlackRock, who's constructive on corporate credit. And the two that are bullish are pointing to corporate earnings. And the two that are super bearish right now are pointing to the labour market. And that's the disconnect of the very moment.
How long can the disconnect continue? Is this disconnect something that's secular or cyclical? And this is something we keep talking about. Or is there a breaking point and one has to break to the other? And either corporate profits will precede some sort of hiring boom, or we see the other way around. Corporate profits come down to some of the labor market woes. We did see small business plans for CapEx fall pretty significantly in this latest survey. So again, contradictory signals. Try to get anything consistent. Good luck.
Stocks are up again this morning. Been pretty consistent about that.
That's true.
Up by 0.1% on the S&P 500. With an update on stories worldwide with your Bloomberg brief, let's cross over to Yahara Anand for more. Hey, Yahara.
Hi, John. The Senate Banking Committee will vote tomorrow on White House Economic Advisor Stephen Miron's nomination to the Fed Board of Governors. This paves the way for potentially full Senate confirmation September 15th, just one day before the Fed's critical policy meeting starts. The central bank is widely expected to cut interest rates for the first time since December. Meanwhile, French President Emmanuel Macron is searching for a new prime minister for the fifth time in less than 2 years. Premier Francois Bayrou is formally presenting his resignation to Macron today after he lost a confidence vote in Parliament as he failed to win support for his deficit-cutting plans. Macron says he'll appoint a new premier in the coming days. And the deals keep coming. Anglo American has agreed to acquire Canada's tech resources in a zero-premium transaction, marking one of the biggest ever deals in the mining industry. The agreement gives Anglo access to Teck's much-coveted portfolio of copper mines, and if approved by regulators, the acquisition is expected to be completed in 12 to 18 months. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. More from Yahara later this hour in about 30 minutes from now. Up next on the programme, the morning calls plus Walt Piecyk of Lightshed Partners with Apple, set to unveil its latest product later on this afternoon. Live from New York City this morning. Good morning.
Still looking at a bull market that continues to maybe 6,600, 6,800 by the end of the year and 7,700 or higher by the end of next year. We don't really need a rate cut here, and if we get a rate cut, that increases the odds of a melt-up, and then the valuation multiple is suddenly at 25. 25 is where the tech bubble burst.
Ed Yardeni of Yardeni Research leaning into the so-called melt-up in this equity market if this Fed eases too much. Too much, of course, that's your judgment call. Equity futures on the S&P 500 positive by 0.1% this morning. The Nasdaq up by 0.2. That's the price action. Here are your morning calls. First up, Citi upgrading Dick's Sporting to buy, believing its Foot Locker acquisition will lead to growth. Your second call from KeyBank downgrading Lululemon to sector weight, citing a lack of positive catalysts. And finally, BMO raising its price target on Oracle to $275, highlighting AI-driven revenue strength. Sticking with tech, investors looking ahead to Apple's product launch event at 1 p.m. Eastern Time. Joining us now is Bloomberg Senior Tech Editor Dana Wollman. Dana, welcome to the program. Thanks for being here. Can you just help us understand what we can expect to see later on this afternoon?
Yes, so this should be one of Apple's more significant hardware launches over the past few years. The iPhone has not seen a major aesthetic makeover in quite a few years, about 5, I would say. So for the first time, we're seeing some actually new hardware here, not just new software features. The one that's gotten the most attention just in Bloomberg's reporting so far has been the iPhone Air, which is, true to its name, going to be a skinny iPhone. But don't skimp on the other phones that are coming. I think those might be a little more consumer friendly in that they're supposed to have both battery life improvements and pretty significantly revamped camera setups. So that might offer more to more consumers than just the idea of a skinny phone for the sake of a skinny phone.
That's what I was going to ask, Dana. Is this what consumers are ultimately asking for? I mentioned the Google commercial that's been airing in this country recently, and I'll read the quote out for you. If you buy a new phone because of a feature that's coming soon, but it's been coming soon for a full year, you could change your definition of soon, or you could change your phone. Just how great has competition become?
I think your question is a great one. It's one I've been asking all year, basically. To what extent are consumers really asking for skinny phones? We've certainly seen a variety of them, not just from Apple, presumably today, but also from brands like Samsung. And this really does feel cyclical in a big way. There was a moment a few years ago when all of the phone makers were experimenting with these really sleek, very, very thin handsets. But they do come with compromises, both on the battery life front, of course, but also the camera capabilities. Some of the most advanced camera features do require more literal space inside the enclosure of the phone.
Dana Wellman of Bloomberg. Dana, appreciate your take. Thank you. Setting us up for the big unveil later on this afternoon. Joining us now to discuss is Walt Piecyk of Lightshed Partners. Well, welcome to the programme, sir. In the bond market for a long, long time, they used to call a certain trade the widowmaker. It was shorting JGBs. And ultimately, at some point, things do change. Well, it was the same story for technology. For a long, long time, people betting against Apple were wrong. Are they right to bet against this company now?
I mean, I also heard in your earlier segment talking about these top 10 stocks being dominant. And I remember people telling me that, like, you can't bet against Apple because the money flows into the top 10 stocks are always going to keep it up. And that obviously didn't work. And to your point, there are leaders, historical leaders like GE that for a variety of reasons are no longer leaders. Obviously not putting Apple in the same camp there. But the bottom line is they're trading at an above market multiple 30 times. Not the highest they've ever traded at, but above market, and growth has slowed down. And there has been obviously a lack of innovation. You were just talking about thinner phones and longer batteries. Is that really innovation in 2025 when Google obviously is pushing forward with AI and agentic AI in a lot of their products?
Yeah, so heroin chic phones don't get it done for you. I just wonder going forward, what could get it done for you for them to announce?
I mean, this is not really an event that matters as much for Apple anymore, as crazy as that sounds. And frankly, if you look at the stock performance around product announcements, the day after, the day of, day after, month after, it doesn't really move. When it moves is WWDC. Remember the last time the stock really moved was when they promised all these AI features a year or two ago. Obviously, none of those AI features actually materialize, but that's what people care about, the services side of the business and what the progress is on AI. Because in the meantime, unless they announce an autonomous car or some new product category that can give them 10, 20, $30 billion of revenue opportunity, giving us a thinner phone or something with longer battery probably is not enough to have an impact in the market in the near term.
Well, you've come on the show before and said you think that there needs to be a change in leadership, something that is significant to really show some sort of different pathway ahead. What's your outlook? How do you see this developing since they are losing some of their AI personnel to the likes of Meta? They have been lagging behind the likes of Google when it comes to some of these agentic features. What do you think the evolution is going to be for the likes of Apple?
I mean, and this, by the way, this is not a new topic, and this is certainly not, I've covered the stock for a long time, and it's not something that I've been harping on from the beginning. I've been a Tim Cook fan over the years. I think there's a Wall Street Journal reporter that wrote a book about the pressure that the company even felt internally about the lack of innovation. So what the problem is now is you have this massive transition to AI. So the ability for others to disrupt, whether it's in this product category of phones or a product category that disrupts phones altogether in terms of how we interact with our data, there's obviously real risk. And at the same time, there is not just innovation coming out of the company in terms of new products. And there's no one can suggest evidence otherwise in recent years. The last great products, obviously Watch and even the car project, were with Johnny Ives, who's ironically now working on what possibly could be a competing product with OpenAI.
So what do you think they need to do, Walt?
I mean, they're in a tough spot, probably not allowing or enabling their AI engineers to be poached by Facebook and others would be a good start. Acquisitions can obviously be a way to jumpstart yourself into the area. But again, you started this segment or this portion asking about management change. Sometimes you just need a senior leader that is more product focused, that can drive you to new products, that might be less focused on, maximizing taxes, right? Keeping cash in Ireland, or maximizing gross margin by, all the manufacturing stuff that they've done in China, and someone that can take those chances and push forward and invest the money to get yourself into new products. This is a mega company. I mentioned autonomous cars as an opportunity. There's plenty of other product categories out there that a company with Apple's brand, staff of expertise, right? Great people within the company of Apple, and the balance sheet that they can, I think, get into some new markets.
Well, appreciate your take, as always, sir. Looking forward to the big reveal later on. Thank you. Walter Piecyk there of Lightshed Partners. Use the balance sheet, but not for buybacks, for acquisitions and investing in the much-needed upgrades that the people like Walter and others want to see.
Be bold, be nimble, and how much has their size and some of their past really kind of hampered their ability to look outside the iPhone? You wonder, is it going to be a robot? I mean, that's something that people are looking at to replace the iPhone. I'm serious. People are sick of doom scrolling. You're correct. And so they want a robot to tell them what to do and be their little agent. And that's what I think people are looking for.
When it comes to, though, what is going on at Apple in terms of Tim Cook, I heard you guys on Friday talk about the seating arrangement Trump had at the AI tech dinner. And Tim Cook was across from Trump and to the right. And I'm not even sure if he's going on the UK visit with the president that Jensen Huang is going. And I wonder if actually he needs to be a little bit more forceful in Washington.
Just for the record, I don't want the humanoid robot telling me what to do. I want to tell the humanoid robot what to do. Isn't that the whole point?
Well, that's the
Or you want yours ordering you around.
This is getting really personal, John.
I mean, you just,
I want the robot to tell me where to go, what I need to do, tell me my schedule. I think that would be really helpful. It's
sort of scary.
Right. No, I think, you've got a meeting here. Please go.
Can I just say, based on working with you for a long, long time, taking instructions? I don't know, Bramo.
We're up against the clock,
from a robot? Live from New York City this morning. Good morning. Equity futures on the S&P 500 positive here by 0.1%. A lift into this market going into the opening bell about 60 minutes away. On the Nasdaq, we're positive by 0.2%. As we count you down to that opening bell, just around the corner with your morning movers, here's Danny Berger with more. Hey, Danny.
Hey, John, some great news for United Health over the past hour or so. Shares up 3.9% on the news that 78% of their customers are rated in the higher category when it comes to their Medicare Advantage program. This is important because those higher rated users mean that United Health gets bonus payments. They get more reimbursements from the government. It's a company that's been struggling a lot for their things like pricing when it comes to that area specifically. So shares being sent up just under 4%. Meanwhile, to the downside, there is Fox Corp. The succession drama of who takes over Fox Corp after Rupert Murdoch has finally been figured out. It will be Lachlan Murdoch, the favorite son. That means that the three other Murdoch children will be selling their stakes of just about $1.4 billion of worth. That dilutive event means that we are seeing shares falling 5.6% this morning. Finally, wrapping things up with one of the big movers to the upside, that is Nebius. They have sealed a deal with Microsoft. They will be building about $19 billion worth of AI infrastructure for Microsoft. What a return for this company. It had been sanctioned in 2022 because originally it was a Russian company. The CEO then spun off, sold his Russian assets, relisted, or at least re-headquartered the company in Amsterdam. It is listed here in the U.S. So that deal with Microsoft sending shares up by just under 55%, John.
Danny, thank you. Danny Berger with the movers. Looking forward to Danny and Matt working you through the opening bell in the next 30 minutes or so. Bloomberg Open Interest just around the corner. Succession, the last great piece of TV. to be honest with you. I don't think anything's really beaten it since.
Well, I think we're watching it play out in the corporate sphere. Is that essentially what you're saying with the...
That's what Danny was talking about.
Well, which I think absolutely. I think that you're seeing that. And you're seeing that in other spheres as well.
Is that based on the Murdochs?
Yes.
That whole thing?
Was that really?
Was it?
Confession. I haven't seen it.
Oh, you haven't watched it?
I haven't seen it.
Okay.
So I'm going to try to
you should watch it.
Okay. I'm watching Boardwalk Empire. I'm kind of going back. And I'm
you
really
got to watch
enjoying that.
Succession.
Busy catching up on the last 10
I almost wish I haven't seen it so I have something to look forward to because it's that good.
You should watch that, Bramwell. I'm going to move on, but you should tune in. All right. Payrolls revisions out at 10 a.m. Eastern Time. Look out for that. It's the main event for a lot of people following this economy. Mike McKee's going to run you through it now. He joins us for more. Good morning, Mike.
Good morning, John. Well, here's what we get. Every month, the BLS surveys about 161,000 different businesses and comes up with its monthly jobs report, which is then revised twice. But then they revise it again by using actual data, not survey data, once a year. Unemployment insurance tax receipts, they cover the year to March of a year. So this will be April 2024 to March 2025. The final revisions will be announced in January 26th employment report, which basically comes out the first week of February. Now, in 2024, the final revision was 589,000 fewer jobs, but you can see the preliminary number was 818,000, so much wailing and gnashing of teeth when that first came out. And we are expecting it to be revised a little bit higher by January. But the idea that we have maybe lost that many jobs, and the survey we have shows estimates between 200,000 and almost 1 million, is something that people are going to be concerned about. The Fed is obviously aware of all of this, but the question will be, should they have started cutting sooner? And obviously the president may weigh in on all of this with his unhappiness with the BLS. But we also have to point out that when all is said and done, you look at these numbers and you look at the revisions and you look at how much does it really mean? Last year, the 818,000 would have been 0.5% of total payrolls. Private payrolls, 0.6%. You can see the other numbers there. They don't even represent 1% of the overall jobs in the country. They're very small errors, but they are errors because it's a survey rather than actual data. And so you can find something to argue about, or you can say, we have a pretty good data system and we'll make the best of it.
Mike, for once, I'd actually like to give the Federal Reserve some real credit. Based on these numbers, a year ago, a lot of people were criticizing the Federal Reserve for cutting interest rates by 100 basis points on what turned out to be a head fake in the labour market. But won't these numbers later on this morning vindicate the Fed's response to the labour market weakness of last year?
They probably should, John, because they will include the numbers from last summer, and estimates are that the slowdown in jobs was probably even more pronounced than the Fed thought it was at the time. What we won't get is month-by-month figures. Those won't come out until the January release, so we won't know for sure, but it may give the Fed some satisfaction that they were on the right track.
Mike McKee with the latest. Thank you, Michael. When we heard from Chairman Powell, I think it might have been in the last news conference or the one before, when he said, if anything, we were too late last year. And I remember we were all sitting there going, too late. A lot of people thought you shouldn't have cut anyway. Based on these numbers we might get later, it could well support their argument all along.
Why they cut by 100 basis points, even though they had the move in the long end of the yield curve. If you push it forward, though, till now, you wonder if this justifies a more dovish take on exactly how Fed policy should go going forward. So does this vindicate people saying you should do a repeat of what we saw last year?
Well, two things on that point. One, the Treasury Secretary around this table was talking about 50 basis points should be needed in September. But doesn't just vindicate the Fed. Doesn't this vindicate the president for giving Jay Powell the nickname too late? Isn't he almost correct? Jay Powell was too late when it comes to inflation, and now potentially is going to be too late when it comes to weakening labor market.
So I'm going to borrow an argument from Neil Dutta, because I have opinions, as you all know. This is what Neil Dutta said over the last year or so, and he was right to point this out. Neil made the point that the Republican argument around the Biden economy was always wrong because they were drawing too much attention to the Federal Reserve, saying the Federal Reserve were being political, cutting interest rates to support Biden going into the election. What they should have been doing was emphasizing why the Federal Reserve was looking to cut interest rates. And it was because the economy was weak. And that was Neil's argument coming into 2025, that this economy wasn't as strong as people thought it was, that the Biden economy was weaker than people realized. And that should have been the Republican argument all along. Lay off the Federal Reserve, focus on the labor market and the economy. That's an argument, a man with no opinions, that I have a little bit of sympathy with.
At the same time, you could fast forward to now. They say they want them to cut interest rates to allow the next phase of growth. You could say that the economy is weaker than it is perceived to be, and that is the reason why those rate cuts are necessary. Be careful what you wish for. Right now, the risk markets are not necessarily seeing that in any capacity, but that, I think, is really the tension underpinning this.
Let's stick with the economy. James Egelhoff of BNP Paribas revising its long-standing forecast for no rate cuts this year. Now expected consecutive 25 basis point rate cuts through to year-end before moving to a quarterly pace in the first half of 26. James joins us now for more. James, good morning.
Thanks. Great to be back.
Fantastic to have you with us. Let's start with the change, because it is a big change for you and the team. What underpins that move?
So let's talk about the things that haven't changed. We continue to see the economy doing reasonably well. We have a soft patch in growth associated with the tariff transition. We have a labor market where we have demand and supply cooling at a roughly the same pace, where we're not seeing an accumulation of labor slack. And we're expecting a prolonged period of elevated inflation. We've been expecting that since November, and that hasn't changed. Two things have changed for the Fed. One is that the political pressure has become overwhelming. They perceive themselves to be under siege, and there's a strong imperative to try to take down the temperature a little bit and to deliver some easing. Secondly, we're having a more pronounced cooling of labor supply and demand than we had expected. There's a lot of experience historically with rapidly cooling labor demand, and it tends to take on a life of its own when it happens. We know very little about what happens when labor supply cools a lot. It could cool very quickly, or it might not. But the Fed is making the judgment between politics and the risk that the labor cooling and the demand side accelerates, that delivering some policy easing is appropriate.
Do you think that 75 basis points of rate cuts through the end of this year, which is your new call, I believe, would ignite a longer-term inflation? Or do you think that the labor market is weak enough to kind of overwhelm any kind of longer-term inflationary impulse?
For us, in answering that question, it's about accumulation of slack. So are we seeing an accumulation of labor slack? And so far we aren't. So the unemployment rate remains pretty low. It's well within or close to the range it's been in over the past year. And so for us, we wouldn't ordinarily have been expecting a whole lot of policy easing. It's not so much about what we've seen so far. It's about the politics and also about the risks going forward. So we think the Fed is making a conscious choice in this environment to prioritize reducing to the maximum extent possible risks to the labor market, and is accepting some increased risk of inflation, with the thought that it can deal with that later if it materializes.
What's the new 2%? Is it 2.5%? Is it 3%? Is it 3.5%?
So we think the Fed is going to continue to target 2% inflation, but for us, we're going to be a little less surprised going forward if we see high inflation as opposed to low inflation, because we think they've shifted their priorities a little bit. It's a change in reaction function. So it wouldn't surprise us if investors started to think a little bit more about the possibility that inflation might run on average over time a little bit hot to the 2% objective.
When you say the Fed feels under siege in terms of independence, what exactly does that mean? Because the market doesn't think that the Fed independence right now is really at risk.
So we think the market is also worried about the risk of recession, and we think that's helping to keep inflation expectations priced into the market lower. It's helping to push down bond yields, and that makes sense to us. It's hard to rule out the risk that labor demand cooling picks up pace from here, especially if policy uncertainty associated with tariffs remains high. But ultimately, the Fed depends on political support from the White House and from Congress to be able to make short-term sacrifices in the economy to achieve a long-term social benefit, which is 2% inflation. And right now, it seems, based on the media reporting, that the Fed isn't sure it has it. And so it feels a desire to pull back just a little bit.
So you think there's a political implication for them cutting in September?
We think it's part of the calculus for them, is how much is it worth to have this elevated level of tension, and what is the economic benefit of doing that? And right now, given the risks to the demand side of the labor market, there's a credible case to cut. And if that reduces some of the tension that we're seeing in Washington, so much the better.
Your central thesis, though, your base case is that ultimately we can have this step down in payrolls growth, but measures of slack remain stable?
So the Fed can help with cyclical shortfalls in demand, but it can't help with structural change. So if the economy is growing slowly and we're seeing poor job growth because of a structural shock to the economy, it can't necessarily help with that. And so the way we're trying to pull those two apart to see whether it's cyclical or structural is evidence of slack or the likely accumulation of slack over time. So with the unemployment rate pretty steady and with vacancies, jobless claims, layoff rate, all of those things relatively stable, that's telling us that slack is under control, it's pretty range bound, and that In our base case, it's not likely to accumulate.
Let's just take this another step or so. Let's say you're absolutely right and you're seeing things in a way that other people are blind to at the moment. And I know you've got some support out there. It's not exactly a fringe view. Wall Street's very divided on this issue. If the Fed is cutting interest rates and starts to stimulate demand at a time when this economy is supply constrained, you know where I'm going with this. Where does this leave the inflation story into 26?
So we're above consensus for inflation for 2026. We think that the Fed easing rates here supports the economy staying in a soft patch, so it supports it not moving into recession. The fact that the Fed is doing this should make us even more confident that the economy remains robust, that we see positive growth, and that the labor market stays in good shape. And in that environment, we are very comfortable being modestly above consensus and modestly above 2% for inflation next year.
It strikes me that someone has a hammer and they're trying to deal with a social problem. It doesn't feel like this is a very clean way for the Fed to really stimulate job growth, as you were saying, a secular issue versus a structural issue. And I wonder if this is going to be a tension that can continue of a labor market that kind of isn't very exciting to people, low hire, low fire type of dynamic for the foreseeable future. But asset prices can continue to climb, but businesses can continue to deliver upper end profits. Does that divide have longevity, or does it have to end at some point?
The Fed only has one tool. So the Fed has interest rates, and it has to go to the FOMC meeting with the data it has, not with the data that it would like to have or that it might have at a later time. And so it has to make a judgment on what is the best course for interest rates that produces its dual mandate and that produces the sustainability of the institution over the long term. And so it's not an easy call. There's a turning point in the economy. The data is being prone to heavy revision. There are a lot of competing narratives and hypotheses on what's driving the data that we're seeing. And so we think this is the call they're going to make. This is the prioritization they're going to choose.
James, this was fascinating. Appreciate your time. James Ogerhoff there of BNP Paribas. I think we all need to change our views on what a good payrolls print is in 2025 and into 26.
Because it's a supply side story because of immigration and because there isn't necessarily the same kind of population growth. It's just hard to understand what exactly that is when then you get revisions on top of it, because suddenly negative jobs prints look very different than ones with a positive ahead of them.
Those revisions are now and about 20 minutes away. With an update on stories worldwide with your Bloomberg Brief, here's Yahara with more. Hey, Yahara.
Hi, John. Rupert Murdoch and his children have settled their long-running family dispute. Under the new agreement, Lachlan Murdoch becomes the sole beneficiary of the trust that oversees Fox Corp and News Corp, while his siblings walk away with more than $1 billion each. The move ensures Fox News and the wider empire will remain conservative and under Lachlan's control for possibly decades to come. Meanwhile, House Democrats released an alleged birthday note from President Donald Trump to convicted sex offender, the late Jeffrey Epstein. The note includes the sign-off, "May every day be another wonderful secret, complete with a drawing of a woman's body." Trump has denied composing the message or that the note even existed. And Apple is hosting its biggest product launch event of the year today, where the company is unveiling its new iPhone 17 lineup, including its thinnest phone ever, smartwatches, as well as AirPods. The new iPhones and their prices will be closely watched, but as for AI, Apple users may have to wait until next spring for any significant advances in that area. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. Up next on the program, we'll set you up for the day ahead. Plus, Gershon Distenfeld of AllianceBernstein from New York City. You're watching Bloomberg TV.
I kind of think they probably should do a little bit more up front, but I don't think that they will. Because, you know, in their mind, they're kind of worried about like the phantom inflation expectation story or, you know, the threat of potential inflation coming from tariffs. I mean, I think those are really secondary considerations at this point, given what we're seeing in the jobs market.
Neil Dutta of Ranmac thinks we're on the precipice of recession. Live from New York, welcome to the program. Your scores look like this. About 42 minutes away from the opening bell. Futures are positive by 0.1% on the Nasdaq 100, up by 0.2. As we count you down to the opening bell, here's the trading diary for the week ahead. At 10 a.m. Eastern Time, payroll revisions. Later on this afternoon, Apple's iPhone event. Through to tomorrow, PPI data and the Senate banking panel voting on Fed nominee Stephen Miron. Thursday, CPI plus another round of jobless claims and an ECB rate decision on Friday. Going into the weekend, UMich consumer sentiment, then a week tomorrow. The Fed decision is just around the corner. Let's stay on that. Gershon Distenfeld of AllianceBernstein writing, we still expect the Fed to deliver a 25 basis point rate cut in September, with a larger cut more likely than no cut at all. In truth, we think a 50 basis point cut could be easily justified. Gershon's with us here in New York. Gershon, good morning, my friend. It's good to see you.
Good morning, John. Good to be here.
Thanks for coming in. 50 basis points, easily justified. How justified this morning?
Well, let's be clear. I don't think they're going to do 50. I think it is justified. I think we've gotten some clarity. You know, the Fed has been in a difficult position over the past few months, trying to balance the inflation and the labor data. And we got a clear sign. What it told us about the payroll number this time, it wasn't just a 1 month thing. It was that we've kind of transitioned from the past few years where we were creating somewhere of an average of 125, 150,000 jobs a month to more like 25,000. That's a big change. Now, as Chair Powell has pointed out, you got to look more closely at the unemployment rate, which has been ticking up, right? As we know, there's a change in the supply also. But it's really not, it's not a huge number in terms of history. And if you believe that the neutral rate is 3 or somewhat below 3, we're still very restrictive. So I expect the Fed to kind of frame it in that way. They're going to frame it as, you know, the labor market is starting to weaken. Things are still pretty good, assuming we don't get a big surprise in inflation later in the week. And they're going to say we're going to move more towards neutral.
If the Fed could justify a 50 basis point rate cut, why are people so excited about risk assets?
Well, you know, risk assets, I heard you talking about it a little bit earlier. They've kind of become a little bit disconnected from what's really going on. Look, the thought is, and I'm not smart enough to know if this is true, that AI is going to be this big game changer. We're going to have a productivity change. You know, I will tell you that when stocks have been this, I don't want to say overvalued, they've been at these levels, kind of 23 times and stuff. I think the average return over the next decade has been like 2%. So you're betting against a lot of history to say that, you know, again, I'm not talking about the short term. You know, stocks could rally another 20% tomorrow. They can go down to 20%. But I think that, you know, we've kind of borrowed from future returns with the past returns we've seen over the past couple of years to get to these valuations.
Is that true with credit as well? And I'm wondering this, given the fact that spreads are pretty tight, they're the tightest levels going back a number of years, at a time when there are two schools of thought. On one hand, don't fight the Fed. When the Fed's in an easing cycle, that tends to be really good for risk assets. On the other hand, if they can justify significant rate cuts because of weakness, not so great for risk assets. So which side of that are you on? So
I think credit, there's no question credit is also pretty fully valued, maybe even overvalued, but there's a big difference between credit and equities. You know, you and I, we could sit here and talk about where should the S&P trade, or where should a share of Apple trade. The reality is there's nothing pulling it to any price. It's worth whatever the market says it's worth. Bonds are different, right? Yes, in the short term, bond prices can move around, but unlike equities, they're actually contracts. They're legal obligations. So there's only two options. Either the company pays me back or they don't pay me back. So the question really is, you know, if you have this magic model that tells you your bond's trading at 6%, but you say that it should really trade fair value at 7%. However you come to that. That just means if you hold the bond and it doesn't default, you'll earn 6%, not 7%. Not a disaster. I actually think spreads are going to widen from here. And I say this as someone who's primarily focused on high yield. But the way spreads are going to widen is that we're going to see the short end, as the Fed starts to cut more than people expect, we think. The short end of the curve, like high yield's pretty short, 3-4 years, right, is going to come down. High yield yields will come down as well, but probably not as much. So the spreads will widen, but you'll still get above coupon returns in high yield.
So you said that you think the Fed is going to cut more than just once. What kind of cycle do you think we're actually going to see?
Well, again,
every meeting after September?
I think based on what we know now, I say this humbly as someone who recognizes that almost everyone has gotten what the Fed's going to do wrong over the past couple of years, and I don't think I have any insight. And by the way, it should be hard to say what the Fed is going to do. They should be data dependent. They should see the picture. We don't know what the next couple of inflation prints are going to be. We don't know if the unemployment rate's going to go closer to 5, right? But as it stands right now, we think that they're going to err on the side of caution of worrying about the labor market, and they're going to cut 3 or 4 times in the next few meetings.
Hasn't the chairman basically told us that we can ignore hot inflation readings over the next few months? When he comes out in a speech and says you're going to get a one-off inflation hit, but maybe not all at once, doesn't that set us up for the next 6 months?
Well, it sets us up for what economists were telling us originally with the tariffs. It was going to be a one-time hit. Look, I think there's a lot of evidence that, you know, if you look at the difference between goods and services inflation, right? And also we're seeing the labor markets. We're seeing kind of manufacturing jobs cut. We're seeing service jobs such as healthcare increase. And that's hard to say. That's probably the aging population more so than it is anything cyclical. But look, at the end of the day, I think we got to be honest. Also, the Fed. And I don't mean to knock the Fed here, but the Fed. Well, but I am. The Fed didn't see. The stage is yours. It didn't see inflation coming. I didn't see it either. You didn't see it either, right? And it's very, very hard, even when you're getting data in real time, because data is by definition backwards looking. So part of the job of the Fed, and it's hard to say, the Fed has, I think, done a pretty good job from everything we could see now. The worry has been for 2 years now that they're going to be too slow to go the other way, and we're going to go into recession. That obviously hasn't happened yet. We'll see what goes on going forward.
I think Secretary Besson joked here in New York. You were in the room about getting team transiency and getting the band back together again.
Yeah, but also speaking of the Treasury Secretary, he talked about the fact that they want to see more of an Alan Greenspan forward-looking Fed, not a data-dependent Fed, which means that then Jay Powell was basically too late both times. Inflation and now potentially the labor market weakening.
It feels like team transitory is getting the band back together again, based on recent comments from Chairman Powell.
They got the band back together when he came out with that one line and said that we can look through any kind of hot reading. So that's why nobody cares about Thursday's data until they do, until it comes out and it's a 10% level. I'm not saying that that's what it is, but if it is, then we have a different conversation.
But you know what no one cares about?
What?
No one cares about the budget deficit anymore. Well, it's gone. It's gone. Problem solved. And the reality, we focus so much time on the Fed. And the reality is that the correlation between what they do and the longer end of the curve, which one could argue is more important to the general health of the economy, it's broken down. And I think it's going to continue to be that way until there's a real problem.
Gershon, it's good to see you. As always, sir. We're out of time, but ultimately I'd love to talk to you for another 30 minutes on the same issue. I think we all would. Gershon Distenfeld of AllianceBernstein. Coming up tomorrow, Peter Chi of Academy, Jim Zelter of Apollo, Seth Carpenter of Morgan Stanley, Lisa Hornby of Schroders. From New York City this morning, good morning to you all. This was Bloomberg Surveillance.